again in September, and maybe if that's the last one ever. I'm more interested, Paul, a little bit in today's market action, looking at Treasury yields about 4 or 5 basis points higher across the curve. In particular, it feels like people are, trying to get flat their positioning before tomorrow's meeting, because even though the Fed's likely to hike, there is a lot of uncertainty around what the future path might be. So I think that's one of the reasons you're seeing, people kind of get out of long positions right now in the market.
And especially because you're specifically talking about positioning, with the July rate hike having been so well telegraphed over the past 6 weeks or so, could the reaction across financial markets, if you're looking at the bond and the stock markets, really hinge on Powell's rhetoric? Because as you know, with this meeting, we're not getting the quarterly economic projections or the dot plots. We're just going to have the statement at 2 o'clock, and then obviously hearing from the man himself at 2:30 tomorrow afternoon.
Yeah, so I agree. It's all going to be about the rhetoric of what Powell says. It's going to be how the market takes it, and as well as some of those keywords. Now, interestingly, the statement that we get at 2 o'clock could be market moving. And historically speaking, outside of the last 6 months or so, the statement has always been the key indicator for markets, and that's when you've seen a bulk of the move, not only because the Federal Reserve announces if they've moved or not in there, but because they make nuanced changes as to their outlook of the economy and inflation in particular. And so you watch that first paragraph. The end of the first paragraph in the statement talks about inflation still being too high. If the Fed adds like a caveat to that, saying that inflation remains too high but has been moderating, for example, that would be that dovish tilt, and you can wind up seeing probably rates markets rally a fair bit if they do in fact make that kind of remark. Now, Jay Powell, half hour later might come out and say, and give a lot of nuance around that yes, it's moderating, but it's still too high. We're still going to be very keen on trying to get that inflation more more moderate. But I think that there's a lot of things that from Powell's perspective, he can hang his hat on and say, hey, job's not done, but at the same time, that doesn't mean we have to hike much more.
Ira, what's the rates market kind of pricing in for a recession? Is that something that the market is anticipating here, or has that kind of been taken off the table a little bit?
Well, the rates market being inverted still tells you that at some point in the future, the market still sees the Federal Reserve cutting interest rates. And when you look at things like overnight index swaps and Fed funds futures and other short-term rate instruments, the market is pricing for cuts starting next year. So the market certainly thinks that we're going to have enough of a slowdown and enough of a decline in inflation that the Federal Reserve is going to be cutting rates. Now, what's interesting about this, Paul, and I've mentioned this to you guys before, and I think this is incredibly important. The market's not actually pricing for 75 or 100 basis points of interest rate cuts next year. It's pricing actually for the Fed to do nothing or the Fed to cut much more than 100 basis points. So when you look at the options market and what the option market's pricing, it's pricing for Fed fund futures not to be at 96, but either to be at 96 or at 98, right? Which means that basically you have 200 basis points of cuts, whereas 96 is where the market's priced right now for the end of next year. So there's like this bimodal distribution, and all that we're pricing right now is for the average of that bimodal distribution.
What would be the catalyst for the cuts?
Well, it has to be a slowing in growth and an increase in unemployment. So, I think Jay Powell could communicate a little bit more forcefully what would have to happen in order for the Fed to cut rates, and it has to be, one, inflation obviously moderating a little bit further, but you get a headline and core inflation below 3%, and I think that would be enough. But it's really has to be a significant increase in the unemployment rate, and you have to start to see job losses. So I think a necessary condition will have to be a recessionary type levels in a lot of indicators, and we're just not quite there yet. We are in one or two indicators we're close, but when you look at the job market, for example, we haven't seen any job losses. You're not in a recession if you don't lose jobs.
So Ira, I think the market call on this Fed is that this Fed was late to the party in terms of, getting on top of inflation. But now some people are also suggesting that, all right, maybe they're staying too long at this party here, that they're being too aggressive for too long. What do you think?
Well, yeah, it's hard to judge ex ante, obviously. I think that they've probably done enough. I don't necessarily think that tomorrow's hike is going to mean anything for the economy in the medium term, one way or the other. I think it's more of a signaling. It's more of a signaling move. The Fed was concerned, I think, going into the June meeting, that the market was still pricing for interest rate cuts before the end of this year. And I think, even if the Fed had stopped at 4.75 or 5%, they would have been able just to hold the interest rates there for a long period of time. So I think they've had a challenge with communication and with trying to tighten financial conditions. And one of the reasons for that is the sectors that are moving the inflation right now are not particularly interest rate sensitive. Most service sector inflation comes from things like wage growth, and those sectors usually aren't very highly levered and indebted. So it's not like you're seeing a significant shift in the demand for those services. Whereas things like automobiles, you're seeing used car prices and new car prices both starting to come down, in part because credit is tighter, and you are seeing a slowdown in even though house prices haven't come down, you're seeing a lack of turnover there, and because people don't want to get out of their houses because of their low mortgage rates. So you are seeing an impact of these higher rates, but it's going to take a long time because of the structural nature of the inflation that we're getting.
All right, Ira, great stuff as always. Ira Jersey, he's a chief U.S. interest rate strategist for Bloomberg Intelligence, coming to us from our Princeton University office, right across the street from the university.
I'm wondering if he has these soccer suspenders.
Well, he can break those out at any time. I mean, I actually watched
blazer.
I watched the Women's World Cup match last night. Boy, they're good, and they're physical too.
And they've been great for a couple decades.
Yes, but I watched a random match. It was like South Korea and somebody like Ecuador, Colombia, and it was a good match.
Yeah, the women's team USA always delivers.
Yeah, they've been good. You're right, for so long.
Yeah,
winning.
Mia Hamm in the late '90s, early 2000s, just keep it going.
So Ira's all over that. So he covers the interest rate stuff, and he does the soccer for us as well. S&P 500 here up about 0.1%. The Dow Jones Industrial is unchanged. Nice lift to the Nasdaq, up a half a point ahead of those big tech earnings. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
All shares of Spotify are down more than 12% after the company reported more users than expected, but revenue slightly below estimates. And this comes a day after the music streamer announced it would raise the price of its U.S. subscriptions. Bloomberg's Lisa Mateo reports.
The music streaming platform's second quarter results showed total active users rose 27% to 551 million. The company cited strong growth in all regions, especially among Gen Z listeners. Yesterday, Spotify announced its first price hike since its launch. Its premium plan will increase by $1 to $10.99, right in line with Apple Music and Amazon Music, who also raised their subscription prices. Steve?
Thanks, Lisa. Last year, Verizon raised prices on its mobile phone plans. Now it's boosting the monthly cost of its wireless home internet service. Bloomberg's Gina Cervetti reports.
Steve, the company will increase the service by $10 to $35 a month. The change will happen later this summer. This is internet service that comes from cell towers. The wireless broadband offer is for new customers and requires subscribers to take Verizon's Unlimited Plus plan for mobile phones. Verizon and T-Mobile have been using these offerings to compete with cable companies.
Thanks, Gina. This morning, Verizon topped analyst estimates for the quarter on profit and subscribers. That's good news for the country's largest U.S. wireless carrier, who's been hit with concerns over customer growth and potentially high costs related to cleanup from lead-covered cables on parts of its network. Currently, shares of Verizon little changed. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. This on a day with the major averages. Right now, they're all in the green. Fed tightening hasn't totally steamrolled the economy. Consumer confidence advancing in July to a 2-year high, getting a lift from the strong job market as well as the easing rate of inflation. The Conference Board's index rising to 117 this month. It was 110 in June. And a bold call from Double Line Capital's Jeffrey Sherman. He says markets should brace for a deep recession that warrants a dramatic 1% point interest rate cut by the Federal Reserve. Among some of the individual stocks on the move, Biogen says it will cut 1,000 jobs. That's more than 11% of its workforce, and reduce operating expenses. This is an attempt to grapple with declining sales from its biggest drug category. S&P 500, 9 points higher. That's up 0.2%, 4563 on the index. The Dow Jones Industrial Average up 16 points at 35,427. NASDAQ 100 up 89 points. That's a rise of 0.6%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess and Paul.
All right, John Tucker, thank you so much. We appreciate it. Jess Met and Paul Sweeney here in the Bloomberg Interactive Broker Studio. And, of course, we are streaming live on YouTube. You can head over to that intraweb thing and search Bloomberg Global News, and that's where you'll find us. So we're right in smack in the middle of earnings season here. Lots going on, but we do have a big day tomorrow for the market, and then as the Federal Reserve is going to meet, and we're going to hear what they're going to do with interest rates. To get a little bit of a preview here, Lydia Boussour joins us. She's a senior economist at EY Parthenon. She joins us live here in our Bloomberg Interactive Broker Studio. So, Lydia, what do you guys at EY, what do you think you're going to hear from this Federal Reserve tomorrow when we hear from Fed Chairman Jay Powell?
Sure. So I think at this stage, the 25 basis point rate hike is pretty much baked in. So the focus will really be on the press conference. I think Fed Chair Powell will want to maintain that hawkish tilt and keep the options open in terms of potentially hiking again before the end of the year. So we're likely to see to still have that hawkish tone, and at the same time also sticking to that slower pace of tightening. So in our view, we're likely to see the Federal Reserve skipping another rate hike in September. And by November, we think that the economic activity will have slowed significantly, and we will have seen inflation also coming back down quite significantly as well. And that will lead the Fed to stay on the sidelines. And so we think tomorrow is going to be the last rate hike in this cycle.
When it comes to economists and their recession calls, it's really become dicey. If you look at the ECFC function in the Bloomberg terminal, the revisions for the second and third quarter have been adjusted higher. How do you view where the economy is projected to go in the U.S.? Because even just looking at the IMF this morning, they ended up lifting the world outlook just based on the strength that we have seen in the U.S. and the stability there.
Yeah, I mean, we've seen some encouraging signs for the economy when we look at the latest economic data, and from our conversations also with our clients, we are seeing more caution from consumers and businesses, but we're not seeing a private sector retrenchment in terms of activity. So we are seeing a downshift in economic activity. We are seeing that moderation in inflation, and we are also seeing that soft rebalancing in the labor market, and that's definitely led forecasters to raise their expectations for growth this year, and also it has also led us to lower our odds of a recession. Now, I think in this environment, it's still important to remember that there are some strong headwinds currently facing the economy, and that includes tighter credit conditions, and that's going to continue to put downward pressure on the economy in the second half of the year. So we are expecting to see some mild recession conditions later this year.
The U.S. consumer confidence came out, as John Tucker was just reporting, a 2-year high. If I'm the Federal Reserve and I see that data point, I'm like, I can raise rates some more. Do you think that's a risk?
Yeah, I mean, consumers have showed some resilience. We've seen consumers continuing to spend despite higher interest rate, despite the fact that credit has become harder to access and more expensive. And so that resilience has been tied to excess savings and the fact that they've been able to draw down on these excess savings to continue to spend. And at the same time, it's important also to think about some of the headwinds facing the consumer. We still have high inflation. They can no longer rely on these excess savings to support spending. And when we look at the fall, we're going to have the restart of the student loan repayments, and that's also going to be a headwind for the consumer. So the consumers continue to spend, but they are more cautious. They are also more selective with their spendings.
On Friday, we actually get the employment cost index, which is quarterly. We all know Powell and other policymakers watch that very closely to gauge wage inflation, but also their preferred gauge when it comes to PCE. And then in between this decision and then the one on September 20th, we still have a batch of other CPI data, PPI, as well as PCE. Will that be enough to where, if it continues to ebb, be enough for the Fed to actually conclude this tightening cycle?
Yes, that's the real question. I mean, the Fed has become extremely data dependent, and so they're going to be closely looking at all these incoming data between now and September to make a decision, and that's a key reason why they really want to keep options open to that, to a potential rate hike. When it comes to wage growth, we know that the Fed is going to be closely looking at the ECI. I think there are some good reasons to think that we're going to see some moderation on the wage front. We've seen that rebalancing in the labor market making some progress, and at the same time, we are also seeing the services side of inflation also starting to cool as well. So we're expecting, wage growth to moderate, to show some slight moderation on Friday, and then also looking at the rest of the year.
Lydia, can you explain to me and to our listeners why inflation in Europe is so much more persistent and difficult? Than it is here in the U.S.?
I mean, I think when you look at what's been happening in Europe, part of the story has also been tied to labor markets. So there is some labor market tightness, and that's also what we've seen in the U.S. And then, if you look at the economy, we've also seen some resilience in the European economy. We've seen, the European economy performing quite well over the winter.
U.S. pull off a soft landing because of the dynamics with inflation being very different here than overseas.
The economy, I think there is a chance that we could see a soft landing. I think the runway for the soft landing has become wider as we've seen that moderation in inflation, as we've seen that resilience in economic activity. The economy is slowing, but it's not retrenching. So consumers and businesses still spending and hiring, and the labor market as well. We need to continue to see that rebalancing. I think when you look at the labor market, what's really encouraging as well is that rebound in the labor supply and the fact that labor force participation has also been rising when you look at prime age labor force participation. So if we continue to see that rebalancing between supply and demand, and we continue to see that moderation in inflation, there is a chance that the economy, could, pull off that soft landing.
I think the economists are going to have to rewrite some of these textbooks going forward, because I don't understand and can't explain really why our labor market is as strong as it is here in the United States. Do you have a theory?
I mean, the tightness we're seeing in the labor market right now is reflecting some of the labor market dislocations that we've seen during the pandemic. We had this dramatic shock that really led to a huge decline in the labor supply, and that came at a time when labor demand became very strong. And so that mismatch in the labor market has really generated a lot of labor market tightness, and we saw wage growth, raising very rapidly. Some of these labor shortages have eased, and so that has led to the beginning of a moderation in wage growth. But some of these labor shortages are also going to continue moving forward, and then we also have some demographic factor acting in the background as well, and pulling down on labor force participation.
So if the Fed does indeed raise rates at least 2 more times this year, could that potentially be the policy mistake if we're waiting for those lagged effects after the last 10 meetings where they raised rates, that investors and everybody in the U.S. seems like projecting where this recession could be headed, that everyone was waiting for, that could actually end up potentially tilting the economy into either a recession or just a regime of slower growth?
Yeah, I mean, it's really hard to gauge, and that's, the key question, how to calibrate policy just enough to get that soft landing. We do think, given our forecast for inflation to come back down quite significantly, we have headline inflation at 3% by the end of the year. We have core inflation between, around 3.5%, 3.7% by the end of the year. And then when we look into 2024, a further moderation in inflation. So we do think that given the outlook, that those rate hikes would be unnecessary in this context.
So just lastly, quickly on the core PCE, we're going to get that on Thursday. Consensus is 4%, down from 4.9% the prior period. It's going in the right direction.
Yes, I mean, core PCE inflation is going in the right direction, and core inflation in general. I think if you look at the rest of the year, we're likely to see headline inflation moving sideways as we got past these base effects. And I think the action is really going to happen on the core inflation side, and we're likely to see further disinflation in core services inflation heading into 2024.
Sounds good to me. I don't know. Lydia Boussour, she's the expert. She's a senior economist at EY Parthenon, kind enough to come into our Bloomberg Interactive Broker Studio. We appreciate that. Thank you so much, Lydia. Looking at these markets just real quickly, Jess, a little bit of green on the screen. I think people are kind of sitting on the sidelines waiting for what we're going to see tomorrow.
And also on Thursday will be the first reading of second quarter GDP that did get revised a bit higher. If you're looking at the Atlanta Fed now, though, they're thinking it's going to come in around 2.4%.
Oh, okay.
Yeah, so that's something we got to keep an eye on Thursday.
Right, so some decent GDP growth,
right.
Moderating inflation. What's not to like there? And that's maybe what the market's reflecting. Right now, let's head down to Washington, D.C., get world and national news with Nathan Haight.
Paul, Florida Governor Ron DeSantis has been involved in a car crash, but his campaign says he is not hurt. A spokesman for the Republican presidential candidate says it happened this morning on the way to an event in Chattanooga, Tennessee. Spokesman says no one on DeSantis' team was injured either. The Florida governor is currently running second in most GOP primary polls. China is getting its second foreign minister in just 7 months. The nation's top legislative body held a snap meeting overnight and came out of it saying Qin Gang will be replaced by the man he just succeeded, Wang Yi. Bloomberg's Anne-Marie Horder reports this raises even more questions about what happened to Qin.
This is the former U.S. ambassador. He was elevated at a very young age, one of the youngest we've seen in 70 years, to be a foreign minister in China, handpicked, and he's been missing for a month.
Bloomberg's Anne-Marie Horder reports China's foreign ministry has only said Qin Gang was suffering from a physical condition. Later today, President Biden will enshrine a national monument to Emmett Till, signing a proclamation preserving the sites connected to the 1955 lynching that galvanized the civil rights movement. Bloomberg's Jody Schneider reports the president may also have 2024 politics in mind.
President Biden, who is running for re-election, really wants to shore up his ties with black voters. They were a key bloc that really helped him win both the nomination and the presidency in 2020. But recent polls have shown that his approval rating among black voters is slipping somewhat.
Bloomberg's Jody Schneider in Washington. The White House is also looking to improve insurance coverage for mental health, proposing rules that would make it harder for insurers to get around federal law that requires the same type of coverage for mental health issues as physical ones. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Recent economic data have reinforced hopes the U.S. can avert recession. And this morning, more evidence of that. Consumer confidence rising to a 2-year high. Earnings also in the driver's seat today. Later today, Microsoft and Alphabet, they're set to report the first earnings since artificial intelligence, that mania broke out. In the meantime, Eric Friedman at USB Asset Management says investors should consider broadening out their stock holdings.
It's really going to be a test to see if this market does buy into the idea of a soft landing and a gradual recovery. That would suggest that you need to get involved in some of those catch-up trades. We'd also include real estate, energy, and even utilities in that category of let's call it areas that have not been rewarded yet, but certainly could be.
Right now, the S&P 500, 5 points higher. That's up 0.1%. 45.60 on the index. The Dow up 11 points. The NASDAQ 100 is up 68 points. That's a rise of 0.4%. And this is not going to help inflation. We could soon end up paying more at the pump. ExxonMobil shut a gasoline unit at one of the largest U.S. refineries. They have to do unexpected repairs at the Baton Rouge facility, the resulting supply disruption that could last for much of the rest of the summer driving season. We checked $3.50 at the Wawa this morning per gallon. So
good to know.
Maybe that's going to go up. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess and Paul.
Thank you, JT. We appreciate it. And this is such a huge week, Paul, when it comes to earnings. So you have around 170 companies in the S&P 500 reporting, and that accounts for about 40% of the index's market cap. Clearly, everybody looking ahead to after the bell today with Microsoft and Alphabet reporting. We also have Meta after the bell and the Fed's decision on Wednesday. So who better to bring in than Bloomberg Intelligence senior tech analyst Anurag Rana to preview what's happening with these big tech earnings. So ahead of Microsoft and Google, what are you expecting? Because it seems like AI and delivering on this is the big key when it comes to these earnings reports.
Yeah, AI has been a big force for the entire tech group. And, at least for Microsoft, we think that the cloud results are going to be pretty average compared to, what they guided. But the real call is going to be on the commentary. What do they say about future prospects of cloud growth over the next quarter or 2 quarters? Because that is going to drive the sector. That is going to drive software. Almost everything hinges on Microsoft's commentary about cloud usage over the next 6 months.
All right, I'm not sure I'm buying this whole AI thing. I think AI is just tech.
Also, what is the best way to gauge it from their earnings report when you have a lot of these companies like Microsoft that obviously are in other dynamics and other percentages when you're looking at what comprises their earnings reports as far as how to show, is this really feeding through when they're really making and deriving their revenue growth in other places when it comes to other cloud growth?
Yeah, for Microsoft, it will be the cloud infrastructure. So let's preview that for a second. Last year, that product called Azure grew 46% in constant currency. Going into this quarter, it's expected to grow at around 27%. So which means that's, a drop of over 20%. If they go out and say next quarter we're going to see an improvement in growth rates because of AI, then you see that monetization. If they say it's going to take 6 more months for us to catch up, then you still haven't hit the bottom for cloud growth. That means you're still seeing declining cloud growth, and that's what dictates valuations going forward.
What else does Microsoft need to get across on this earnings call here? Did they just need to say AI like 40 times and they're done?
So this is a company that can actually infuse AI across their entire portfolio, whether it's Office, whether it's the search engine Bing, whether it's software application products. So they have a little bit of a leg up compared to AWS, compared to Google Cloud Platform because of their relationship with OpenAI. This is kind of the early lead that they have because of it. Now, all the others are running and trying to get their software models in place and trying to come up with products. But I would say Microsoft probably has a 1-year leg up before everybody else catches up.
When you're looking at the movement of these stocks, especially Microsoft, been trading at records, looking at this stock, ticker symbol MSFT, up about 46% year to date, then moving over to Alphabet, 37%. Is it possible that even if they do deliver, we might not see the price reaction that we would normally expect because we've seen such big moves so far this year?
Yeah, it's very much possible. It could be, traders selling on the news. That's absolutely possible. When you look at Microsoft, you said, up 43% year to date, but the revenue estimates are down 2%. So think about it, that the actual numbers or the growth rate of the company is depressed. It's all the promise of AI, and how they deliver that promise for the next 12 months is going to be most critical on the call.
All right, I mean, here's a company with north of $200 billion in revenue. What's the company of that size grow going forward, do you think?
I had a feeling you'll ask me that question, Paul. I'm not going to lie that. So let me actually put it back to you and say, if a company like this grew 15% over the last 4 or 5 years, and I would say, forget about the revenue size and anything about the company, you have the promise of AI. You have so much workloads that are still on premise, about 75% of them. You have productivity applications. What kind of growth rate you would give for them for the next 6 to 7 years? Without even knowing the financial model, you say, yeah, I can grow about 10%. It's not bad. That means they will double the size of their revenue in the next 6 to 7 years. That's not bad, I mean, for a company that size.
But talk about the valuation here.
That's the hardest part. The valuations have gone up way too much for the entire tech sector. Is it in the nosebleed category? I don't think so, but we are still running into the risk of continued slowdown in tech spending over the next 12 months. If that happens, then there could be some kind of, you could say, going back to the normal for a lot of these names.
Yeah, and especially with Microsoft trading around 31 times estimated earnings. Whoa. It's above its long-term history and a premium to the NASDAQ 100, but still when you're looking at the NASDAQ as well, still kind of lofty around 30 times there. So when it comes to Microsoft, still generating billions from software products and cloud business, and then you look over at Google, and clearly the ad engine remains what has been really unrivaled when you're looking at its competitors. What specifically when it comes to Alphabet do you think needs to be delivered there?
Yeah, I mean, I've talked to Mandeep quite a bit about it. He covers Alphabet, and his thesis is it's either going to bottom out this quarter or next quarter when it comes to some of those ad monetization. And if that piece is right, Google is one stock that has not seen that level of multiple expansion as we have seen some of the others.
Talk to us about just the cost-cutting story within technology. And that's never been really part of the pitch that you and other tech analysts had. You guys are always just top-line growth, new products, new services, don't worry about it. But now a little bit talk about costs. How do you think we'll hear from Microsoft and others this earnings cycle?
If they're able to project that their revenue is going to go up next year, I think the job growth comes back with it. There has been a massive correlation between headcount growth and revenue growth for almost all of these companies. For Microsoft, that ratio is about 0.8. So for every dollar of revenue that you get, you need 0.8 human beings out there. With AI, maybe that goes to 0.7, but you have to hire people in order to surface that new growth that's coming in.
And especially if we're talking about the cloud, I have to bring up Amazon's reporting their earnings next week. What are you looking ahead to for them?
I think it's going to be weak. I think it's going to be weak over there because they don't have an open AI that can counter a lot of the corporate IT spending slowdown that I've been talking about. We have seen results from IBM, Accenture, Infosys. All the companies are basically saying their bookings are going down, tech spending is slowing down, consulting is slowing down. It has to translate into slower cloud growth also.
Well, how does Amazon not have an AI angle?
Right.
Yeah, I mean, they have it. You have to, go buy their infrastructure to develop a product out there. It's just this collaboration between Microsoft and AI that ChatGPT has just become so big. They don't have a ChatGPT equivalent, but that doesn't mean they have the infrastructure. The garage is there. You just don't have the software that goes on top of it.
All right. So, I mean, anything that we should be paying attention to before? Like, give me a name that's going to have rock one way or the other on earnings.
All of them. All of them. Microsoft, ServiceNow, Amazon, I mean, all of them, Apple, all of them had a great run so far. If they show even a slight hint of hesitation or pessimism, it's going to be carnage for a lot of them. Apple, I think, is going to be slightly more insulated because they have I would say, less cyclical of a product. But frankly speaking, their valuations have gone up quite a bit also.
So if you were a trader, you wouldn't be long going into the earnings. You might even be short going into the earnings.
Exactly. I would stay away from trying to short. I mean, I wouldn't short any one of them. I mean, that's going to be very dangerous.
You would not short.
Yeah, I would not.
But you
short.
still think there's risk though because of some of the
because
earnings.
you come out and say, I got 4 new AI products coming in, people will ignore everything that happened in the backyard, and they will say, okay, this is the right AI play for me. I'm gonna ride on it.
All right, Anurag, thanks so much for joining us. Anurag Rana, Senior Technology Analyst at Bloomberg Intelligence. We got him here in New York, which is a good thing. He, along with Mandeep Singh, they cover all the tech stuff for us. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul's sweeping cost cuts fueled better than expected earnings and cash flow for 3M. The company's profit topping Wall Street estimates in the second quarter, driving a rise in the annual outlook. CEO Mike Roman said 3M is also moving forward with the spin-off of its healthcare business. 3M stock is currently up more than 5.5%. General Electric raised its full-year guidance and reported second quarter results that blew past expectations. The company points to a renewables rebound and surging aerospace demand for jet engines. CEO Larry Culp says the results also show a strong start to the year. General Electric shares are up more than 6% this hour. The head of Novartis says U.S. drug pricing reform poses a risk to public health. Bloomberg's Jeff Bellinger reports.
Steve Vassant-Narasimhan says the Swiss drug maker and its rivals have already begun to cut investment in pills for the elderly, which under the Inflation Reduction Act will have a shorter exclusivity period of 9 years, compared with 13 years for drugs delivered as infusions. The reforms in the IRA allow Medicare to negotiate drug prices for the first time. It starts with a select group of medicines to be announced by September.
Thanks, Jeff. Currently, Novartis stock is up more than 0.5%. UPS and the Teamsters Union head back to the bargaining table today. While the company and the union have agreed on a number of issues for a new contract, the union is still pushing for better wages for part-time employees who account for about half of UPS workers. Some 340,000 employees could hit the picket line if no deal is reached by August 1st. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Hey, Paul Sweeney and Jess Menton here in the Bloomberg Interactive Brokers studio, looking at these markets here. A little bit of green on the screen. Not a lot of movement. The S&P up about 1/10%. The Nasdaq up about 0.3%. We're seeing yields just slightly higher here. The 2-year Treasury's up 2 basis points, 4.88%. The 10-year up again about 2 basis points, 3.89 on your 10-year. WTI crude oil up just slightly, up about 0.5%, $79.12. So we'll keep an eye on oil, which has had a nice move higher for oil traders in the last month or so. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
Paul, House Speaker Kevin McCarthy has dropped his strongest hint yet that Republicans on Capitol Hill could be moving to impeach President Biden.
We will follow this all the way to the end, and this is going to rise to an impeachment inquiry the way the Constitution tells us to do this, and we have to get the answers to these questions.
Speaker McCarthy made those comments in an interview last night with Fox News host Sean Hannity. The questions, he says, are raised by IRS whistleblowers and an unsubstantiated FBI document about the Biden family's foreign business dealings. A White House spokesman responded to this interview on Twitter last night. He says Republicans' eagerness to go after the president, regardless of the truth, is, quote, seemingly bottomless, end quote. Florida Governor Ron DeSantis was caught in a car crash this morning on his way to an event in Chattanooga, Tennessee. A spokesman for the DeSantis presidential campaign says neither the governor nor any member of his team was hurt. The spokesman put out a statement saying they appreciate the prayers and well wishes of the nation. Investors and lawyers in Israel trying to figure out what comes next. That's after Prime Minister Benjamin Netanyahu's government passed that new law blocking judges from overturning government decisions they consider unreasonable. Bloomberg's Ethan Bronner reports from Tel Aviv at least 7 petitions have been made to Israel's Supreme Court to overturn this new law.
In the kind of high-tech and finance and business sector of the society, there is an enormous amount of angst. I think it's fair to say on the other side, in the more populists, the supporters of the government, there's joy. So it's mixed and it's split.
And Bloomberg's Ethan Bronner reports it could be the first step for the Netanyahu government after the summer break. It says it wants to make it easier for politicians to appoint judges and harder for the Supreme Court in Israel to overturn legislation. Russia is expanding the draft as the war in Ukraine moves into its 18th month. The Kremlin is raising the upper age limit for military conscripts to 30. A researcher at the Moscow-based Gaidar Institute says that could add another 2.4 million Russians to the draft rolls. But Russia has said those draftees would not be sent to fight in Ukraine. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg. Paul and Jess.
Thank you, Nathan. We appreciate it. And Paul, whenever I'm not here with you, I do have my day job.
Apparently so. You write a lot of stuff.
So I wrote today's Taking Stock column, and it's about how your buddies over at Bloomberg Intelligence, so Gina Martin Adams, Jillian Wolf, crunching the numbers here, talking about how a technical indicator has a 100% track record that to them signals the bull market run. So when you're looking at, for those who closely follow Fibonacci analysis on the tech...
He's a big Fibonacci guy.
He is, apparently. So earlier this month, we did see the S&P 500 cross above 4505. So that would technically be a 76.4% retracement of when you're looking at the peak to trough decline from the January 2022 highs to the October lows. And really, that's just telling you we've seen such an extreme movement there off of the lows that typically, if you're looking back since 1929, every single time this has happened, the S&P 500 indeed ended up being in a bull market and didn't retest those lows.
Yeah, no, when we hired Gina, I didn't know there'd be so much math in her stuff, but it's
She's
very
amazing.
good.
CFA, also a CMT.
I know,
She's doing both, best of both worlds there with the fundamentals and technicals.
Sandwich at the Italian
Fibonacci.
deli.
Exactly.
Yeah, is that?
She's got a chart in here and everything that kind of shows, the potential for the upside here, and it's timely research because a lot of folks, including myself, said, "Boy, we had a great first half of the year.
Right
now, where do we go? I mean, and is the market too far over its skis? But we just had another great month in the month of January.
Yeah, and especially
July,
the June swoon did not come to fruition,
Yep.
and still a strong July, and usually that is strong. So that holding to historical patterns, Paul.
All right, good stuff out of Bloomberg Intelligence, Gina Martin Adams and her strategy group looking at this market from a technical perspective. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Dana Peterson. She's the chief economist at the Conference Board. Because the Conference Board came out with some, I think, really some upside potential or some upside news here on the consumer. The consumer putting out some very good numbers, both present situation and for expectations. So we'll break down the consumer confidence numbers with Dana. Plus, Lee Klaskow, senior transportation analyst at Bloomberg Intelligence. We're going to talk to him about UPS and Teamsters. Is there going to be a strike? Are we still going to get our packages delivered to our doors? We'll break all that down with Lee. But first, let's kick things off with John Tucker and get a Bloomberg Business Flash.
All right, let's start with confidence in America's economy at a 2-year high. This is a pretty surprising development. The resilient labor market, moderating inflation behind it. This comes from the Conference Board this morning. This suggests recession fears may be misplaced. Drew Mattis at MetLife doesn't see an economic slowdown in the immediate future.
Well, the good news is there's not going to be a recession this year. The bad news is it's still coming. We've had to move back our forecast from mid-year to the start of next year. The reason we went that far, actually, is because we think consumers are still in this ball game. They're still in this you only live once mentality post-COVID.
Well, the NASDAQ 100 right now outperforming as we wait for earnings from Microsoft and Alphabet. S&P 500 companies with a market cap of $16.3 trillion are going to open their books this week. S&P 500 right now 5 points higher. That's up 0.1%. We're at 4560 on the index. The Dow Jones Industrial Average 14 points higher at 35,423, and the NASDAQ 100 60 points higher. That's a jump of 0.4% right now. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Jess and Paul.
Paul, looking at where the Dow is, coming into today, 11 straight consecutive sessions higher, longest winning streak since 2017. It was a little bit lower pre-market, but now it looks like it's trying to hang on to gains. So potentially that could be also its 12th consecutive day in the green there.
Here that the market, oh yeah, thank you, the blue button. Yeah, it kind of goes to show you, I think the market is just kind of saying, all right, we got this Federal Reserve looking like it's going to raise interest rates tomorrow, but after that, all bets are off here, and the earnings are coming in, I think, okay when you listen to the strategies here. So, the headwinds that had been out there may be kind of dissipating a little bit. So we'll have to see, again, a little bit of green on the screen here today. Let's check in with Alex Semenova. She covers all the markets for Bloomberg News. She joins us here in our Bloomberg studio. Alex, what are you looking at here under the hood for these markets?
So we have been talking a lot about summer travel, summer vacation. So stock that I'm watching today is Alaska Airlines. Shares are down more than 11% after its CFO warned of pressure from declining airfares and softening demand for domestic travel. This so far marks its biggest intraday decline since March 2022. The company forecast revenue will be flat to up 3% in the third quarter, with a midpoint below Wall Street's 2.9% forecast. But importantly, a really interesting commentary from CFO Shane Tackett in an interview with Bloomberg. He spoke about domestic versus international travel demand we saw last week. Some air carriers benefiting from this pent-up demand for international trips, United Airlines, Delta. But on the other hand, Alaska Airlines only caters to domestic travel, so it really took a hit there. Tackett did say, however, he expects a recovery in the winter time once everyone gets those Europe trips out of their system in the summertime.
So, Paul, do you use Spotify? Look at this stock.
I don't.
It's down almost 13%, so it's ticker symbol SPOT. So would be its worst daily decline since October of 2022. What's happening with that stock, Alex?
Yeah, so Spotify reported second quarter revenue that missed expectations. It also gave a revenue forecast below analyst consensus. It did offer a forecast for monthly active users better than Wall Street expected, but that wasn't enough to impress analysts at Bloomberg Intelligence. They said that user visibility stunned while margins disappointed. They put it really well there. And analysts at Citi said that given the margin miss and weaker revenue outlook, it would not be surprised to see those shares move even lower.
Yeah, they're also hiking those monthly subscription costs. I'm actually a user of it. Usually it's about $9.99, but it's going up about $1, $2. Which
I did not know that. I'm
yeah.
very disappointed to hear that.
Yeah, it's not too much. It's more of when you have so many of these different apps, and then they all start
They
whether
start to add
Netflix,
up.
it starts to add up when you have 5, 6 of them. So
You
I
could
just
probably
noticed this
bundle
morning.
them up, you know,
Right.
like bundle up all the apps, and that would
Exactly.
look like a cable subscription.
Exactly. We've been duped.
All right. So, how about if a strategist out on Wall Street, and I'm a little bit I've been cautious this year.
Oh, Alex is all over this. She has to break down the Marco Kolanovic, Mike Wilson dynamic here this week with some of their latest calls.
Yeah, I always look forward to Mondays because that is when their notes drop. And yesterday really showed how hard it is to be a Wall Street strategist this year when the market has defied expectations, when recession calls are being scaled back, and so many people got it wrong going into 2023. Mike Wilson actually yesterday admitted that he was wrong. He said that he didn't see stocks would go this far. He did, however, maintain his bearish call. He sees the S&P 500 down to 3,900 by the end of the year, which is a substantial drop from where it's trading right now. Marco Kolanovic at JP Morgan Chase & Co. also reiterated his bearish stance. He said that the effect of global interest rate hikes, waning consumer savings, geopolitical tensions will eventually weigh on stocks and spur fresh market declines. He just says that he doesn't actually know when that will happen. He says that it's hard to time the inflection point, but it's really, really interesting to see these strategists kind of experience this reckoning where they've seen an incredible run in the S&P 500 and the NASDAQ. They've gotten it so wrong, and now they wonder, should we turn right now? Is it a little bit too late?
Hey, Paul, with your experience on the sell side and doing this since the mid-'80s, whenever you see strategists begin to capitulate like this, but it hasn't come to fruition yet, but you're starting to see that, at what point does it then turn into a contrarian indicator for the stock market, more of like the downside? At what point, because still when you're looking at those average targets for the S&P 500, it's a little above 4,200, well below where the S&P is trading right now.
Yeah, exactly right. And I think as we were talking about earlier here, I mean, one of the toughest things to be is to be really wrong on a high-profile call like a strategist. When you're a strategist, it's a big call for the firm, and to be wrong, your sales force won't even pick up the phone when you call. They won't make phone calls to their clients because their clients don't want to hear an analyst that's been so wrong for so long. So you really get frozen out. It's a very lonely place to be, but a lot of these folks, give them some credit. They stick to their convictions. And that's kind of what we see from a lot of these people. But when you see them capitulate, like you're suggesting, a lot of folks just be like, "Ooh, that's time to get out of the market here." I'll take that as a contra-indicator, if you will. So it's a lonely place to be. I was at Salomon Brothers back in the day, and it was back in the early '90s, market ripping coming out of the recession, and our strategist was very bearish, the lone bear on the street. And then we merged with Smith Barney, who had a strategist who was very bullish. Guess which strategist got the job at the merged firm? So, and my friend's now teaching finance at Baruch College. So
there you go.
That's how it goes, folks. So anyway, thank you very much, Alexandra. Great stuff there. Bringing us a breakdown of the markets. Alexandra Semenova, she covers all of the stuff, all the markets for Bloomberg. We appreciate that. Yeah, it could be a tough place to be there when
lonely place, right?
Yeah, exactly. What are we doing here? Let's talk to Dana Peterson because I don't know. Do we have Dana yet? Because I want to get right to that data.
Yeah, she's here.
Yeah, awesome.
Talking about that conference, consumer confidence, that monthly report that obviously came in around a 2-year high there.
Yeah, I want to get right to that because it came in really surprising, I think, on the upside. Dana Peterson joins us here. She is the chief economist at the Conference Board. Dana, talk to us about this consumer confidence data we got today. Something really got everybody's attention.
Absolutely. It was definitely stronger than what markets expected. And what's important is that we broke out of that range that we had been in for a very long time, seeing the highest reading since 2 years ago. And it was not just present situation, present confidence being elevated, but it was also expectation. So we saw breakouts for both of the underlying indicators here.
One thing I'm curious about, because last week when you were talking to us about the monthly report when it comes to the leading economic indicators still pointing toward a potential recession in the U.S., how do you rectify when you're looking at that data versus when it comes to the sentiment and consumer confidence data?
Sure. Well, the leading index does include expectations. So probably in the next reading, we'll see an improvement in leading indicators, but certainly up through the last measure, it's collecting information on the yield curve, which has been negative for some time. It's also collecting a lot of information on manufacturing. We know there is a manufacturing recession going on right now. So it's gathering up that info, and it's also collecting some of the declines we've seen, or rather a worsening we've seen in jobless claims, which, I mean, are still incredibly low, but it does capture monthly movements. And so when you pull all those things together, it's still flashing red for a recession at some point over the next year. So it's not necessarily inconsistent. Consumers are saying that they're not as concerned about recession going forward, but there's still that risk out there that the leading indicators is showing us.
So one of the numbers that really jumped out at me, Dana, was the Conference Board expectations came in at 88.3. That's versus a revised higher 80 for last period. Put into context what an 88.3 means.
Yeah, so anything above 80 means that consumers are not expecting recession. And anything below means they are expecting recession within the next 6 to 12 months. So we've been hanging out below 80 for some time. So it really is significant that we had one reading that was right on the button and then one reading that's been that was notably above.
Where are the pain points when it comes to consumers? Because it looks like when it comes to, say, some red flags bubbling up, especially when you're looking at auto delinquencies, what is that telling us right now? And at what threshold does it need to end up happening and hit to be more of an issue when it comes to a pullback in consumer spending and what that could mean for the trajectory of GDP?
Sure. So I think you have to break it up into goods and services. For goods, consumers have been feeling the pressure from higher interest rates. And certainly if you're starting to see delinquencies go up, that's because interest rates are rising. So anyone who had been financing something, but usually not a car, because that's usually a 5-year fixed rate, but anything that might be increasing in the rate, then that's going to be a weight on consumers, and they're probably going to pull back on durables. And when we look at the 6-month smooth or moving average of the Conference Board's buying indicators, for the most part, they're showing some weakness. But we also asked a special question about services and what consumers are saying. And services don't usually get affected by the interest rate, which is a big challenge for the Fed. But they're saying they're willing to buy fewer things that they want and more things that they need. And so I think that's significant in terms of a shift in what people are actually spending on when it comes to services. They're spending on things that they can't live without and less on the things that they may just desire.
Dana, the consumer confidence number of 117 here, the highest in 2 years. I would think that a strong labor market has to be a big component of that. Just explain to us how labor kind of weaves into that consumer confidence number.
Absolutely. We ask about labor in a number of places. We ask it for the present situation and for the expectations. And in both of those measures, consumers are saying, yes, we think the labor market's doing well. In terms of current conditions, there are more jobs out there than we even need. So jobs are easy to get. When it comes to expectations, they're saying, yes, we still think we're going to be employed in the future. And certainly when we ask CEOs what they're doing with respect to the labor market, many of them are still saying they're hiring. And then a lot of them are actually just holding on to workers or hoarding workers. They're not looking to let people go. So I think that's also showing up in consumer sentiment or confidence with regard to the labor market. And certainly if you're working and your wages have risen a bit and you're seeing inflation come off and your real wages are rising, you're going to feel better. And I think that's what's being exhibited here in today's report.
Yeah, one of the things that's a new concept to me is hoarding workers. I don't think I've heard of that before. Is that something you economists have seen before?
I'm sure that's happened in the past, but this is definitely something that is very noticeable now. And I think the reason why we're having hoarding is because of labor shortages, and many businesses worked really hard to attract labor, and they're also working really hard to retain labor. And so they don't want to let people go, especially if they think that maybe there might be a recession, but it's not going to be that bad. It's not going to be that long. So if that's the situation, you hold on to your workers, you hold on to your talent, and you don't let them all go and then have to come back 6 to 9 months later and bring them back, rehire them at a higher price point. So that's something that is a phenomenon that, I mean, I can't necessarily say if that's ever happened before. I'm sure it has, but certainly we're seeing it right now, and it's an important development that's affecting the labor market.
Dana, as an economist, how many more rate increases do you think the U.S. economy can handle as we're waiting on those lagged effects?
Well, that's just the thing. The Fed has already raised rates by 500 basis points, and nonetheless, consumers are out there spending, and businesses aren't letting people go very much. So the economy can still handle it. So we expect at least 2 more interest rate hikes from the Fed. Definitely this week, and then potentially in September, although that September hike may be later if the Fed says that they want more time to sit and wait and see how those lags play out. But certainly, for the most part, the economy's been able to manage the increases in interest rates, and it's not clear like how far the Fed can go before the economy itself breaks.
So what do you expect, or what are the good folks at the conference board expect to hear from Fed Chairman Jay Powell tomorrow?
Well, we expect that the chair will say that there have been positive developments. I mean, they're looking at these consumer confidence measures just like we are. We send them to them, and they get it when everybody else does, just to be clear.
Yep.
And they're looking at that. They're also looking at the fact that CPI inflation has come off. That's not their preferred measure, but they're going to get the BEA data later this week. And I'm sure some of the action that we saw in the CPI will be reflected there. So calmer inflation, lower consumer inflation expectations, a more upbeat consumer. Also, we're seeing that, yes, there is this very weak growth in manufacturing, but services is still doing okay. So with all of that, I would say the Fed would be pleased with the slowing in inflation, but not happy with the ongoing strait that we've seen in the labor market that's challenging keeping inflation or helping inflation to fall further. So I think with that, we're probably going to see another hike, certainly this week, and then another one before year end.
We only have about 20 seconds left, but the dissents when it comes to the Fed decision, what are you watching?
Well, certainly there may be some dissents in terms of those who think that the Fed has done enough and we should pause. We've heard that, from a number of participants in the FOMC. So it'd be curious to see if they actually put that down on paper and say, look, we've done enough. We need to sit and wait and see how all these lags work through the economy.
I would be one of those people, just so you know. Dana Peterson, Chief Economist for the Conference Board, joins us here. We appreciate getting her thoughts here. We had some good consumer confidence data coming out from the Conference Board today. 117, the consensus was for 112, so much better than that. And it was the best in 2 years. So how about that? Consumer hanging in there tough. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, the FDIC is warning about uninsured deposit errors at some U.S. banks after dozens of lenders restated the figures in regulatory filings. Bloomberg's Tom Metcalf explains what went wrong.
I think this was sort of one of those metrics that perhaps was not so closely scrutinized, obviously, before sort of the regional banking crisis. Now it is, and it turns out that quite a few of the data points being shared by those banks were off, whether too high, too low. So I think it's, dozens of U.S. banks have effectively had to revise the data they've been supplying. I don't think there's any implication in terms of sort of regulatory fines or anything like that.
Thanks, Tom. Investors began scrutinizing lenders with the biggest uninsured deposits after Silicon Valley Bank and Signature Bank collapsed. Twitter is facing a string of problems with its new branding. Bloomberg's Kimberly Adams reports.
Experts tell Bloomberg turning the platform name into X is set to kill billions in brand value. Elon Musk announcing the product name change and getting rid of the bird logo and all the associated words, including tweet, wiped out anywhere between $4 billion and $20 billion in value. The company has already declined significantly in value since Musk purchased it back in October for $44 billion. Terms like tweet have become a part of popular culture.
Thanks, Kimberly. Rising interest rates and higher sticker prices aren't stopping consumers from buying up gas-powered trucks. That's the word from General Motors, which raised its profit target for the year by at least $1 billion. Second quarter earnings beat analyst estimates on stronger than expected U.S. sales, with gas and diesel-fueled SUVs and trucks allowing it to crank out big profits. Shares of GM currently down more than 4%. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg newsroom with this Bloomberg Business Flash. Right now, the major averages in the green with the NASDAQ 100 leading the way. Microsoft and Alphabet among the early big tech leaders with promising artificial intelligence tools. They report results after the market closed today. That's going to test their recent rallies. U.S. consumer confidence, as you've been hearing, that advanced in July to a 2-year high. It all suggests the economy can avoid recession. Now, as a result of that, you have Treasury yields rising. The 2-year is up at 2 basis points right now at 4.88. Meantime, traders and economists in near unanimous agreement the Fed's going to raise rates by another 0.25 percentage point tomorrow. The International Monetary Fund raising its outlook for the world economy this year, estimating risks have eased in recent months. They say global GDP will expand 3% this year. S&P 500, 7 points higher. That's up 0.2%. 45.62 on the index. The Dow Jones Industrial Average is up 17 points right now at 35,429. And the NASDAQ 100, 88 points higher. That's up 0.6%. And we check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker. That's your Bloomberg Business Flash. Jess and Paul.
Thank you, JT. We appreciate it as always. And Paul, we have this potential UPS strike from workers that might be coming up very soon. So joining us now is Lee Klaskow, who at Bloomberg Intelligence, he's the sector head and senior analyst of freight transportation at BI. He's going to walk us through this. Lee, talk to us about what's happening here. Where do talks stand, and what should we expect to happen from here out?
Yeah, so what we know as of right now is that the two parties are at the negotiating tables. They took a time out because they were really far apart on where part-time wages should be. The Teamsters wanted significant raises, and the UPS put its best offer on the table, and that wasn't good enough for the Teamsters, and so the Teamsters walked away from the table. They've agreed on a lot of other issues. UPS also gave up the recognition of a certain type of driver, to make it just one class of driver. But it's really now the focus is on the part-time aspect. Pay, and we think that cooler heads will prevail. Obviously, as we get closer to that August 1st deadline, the probability of a strike increases. But from our vantage point, the company under the leadership of Carol Tomei truly has at least communicated that they're looking for a win-win-win situation in this negotiation. But I would say the Teamsters, the rhetoric out of their camp is a little more aggressive. There's new leadership there, and I think he wants to prove that he's not like the old leadership, which some people might have thought that kowtowed a little bit too much to the management teams that they were negotiating with.
Lee, I'm probably like a lot of people during the pandemic. Every day the UPS guy showed up. Every day the FedEx woman showed up, with the packages.
Sure.
Talk about essential workers here. Does that factor in at all to kind of negotiations here? Because I kind of feel like I got to throw these guys a little something extra.
Yeah, listen, at the end of the day, during the pandemic, they were essential workers to our everyday lives today. They are somewhat essential. They deliver health care and pharmaceuticals that are important to our everyday life, not just, ordering rubber bands from Amazon. But, they do provide a critical role, not only in the economy, but in our lives. That being said, a UPS part-time driver, on average, according to the company, makes around $20 an hour. And that's not just all they're making. They get health care, and they don't really pay premiums. They get to participate in tuition reimbursement and also retirement plans. So, there are a lot of benefits. It's not just the $20 an hour. Currently the floor for a part-time worker is $15.50 an hour. But again, I think the Teamsters are looking to get that to closer to 20. I think that they're going to find some sort of middle ground. I don't really know if there's going to be a true winner or a loser. I think the part-time employees are probably going to be earning more. And, you know, the union also wants to kind of transfer or create more full-time jobs and less part-time jobs for their members. So I think that's something that they're looking to do as well. And, you know, the union is also looking for maybe, you know, kind of like a one-time benefit for, you know, that work that they've done during the pandemic that, you know, you mentioned. Yep. A lot of them were out there working when most of us were home, you know, cowered in our homes.
Do we know how close the two sides are at potentially reaching a deal?
I mean, I honestly don't. You know, it really depends on how much either side will bend. I'm guessing UPS will get closer to the $20 mark than you know than what the Teamsters might want. But you know, I think they're gonna, you know, at the end of the day, I don't know, but like I think they're gonna find some sort of middle ground, because at the end of the day, you know, while the union, you know, is threatening a strike, most of the workers don't want to strike. It's disruptive for them. You know, there are some workers that might cross the picket lines, and obviously that's might not be great for morale. They get you know, a very small stipend when they strike, something like $500 to $800 a week, which is, you know, not a lot of money, but you know, it's something they get, and they have families to feed. You know, if there is a strike, you know, we believe that it'll be very short in duration. We think anything over a week will be extremely disruptive to supply chains. Obviously, a week strike would still be disruptive to a lot of folks. But you know, it could also be an opportunity for UPS's competitors or even other modes of transportation to pick up more volumes in an area where we're kind of currently in a freight recession, because freight demand has been down for you know, at least a year.
So then what happens if a deal isn't done by August 1st?
It depends. Well, there's a couple things that can happen. The Teamsters can strike, like they said they were going to, or maybe they can have a cooling off period and agree to meet again in a week or two. You know, there's a lot of different things that can happen. But the rhetoric out of the Teamsters is pretty aggressive in terms that, you know, they are going to strike if there's not an agreement reached. So if there is not an agreement reached, I'm assuming that's the likely outcome. And, you know, politicians, whether it's the Biden administration or other organizations, are hard at work making sure that these two groups find some sort of common ground and the strike doesn't happen. You know, UPS touches, it's been estimated, around 5 to 6% of U.S. GDP. I've seen some estimates out there on the Bloomberg terminal about, you know, a strike could add 20 basis points to inflation. So obviously, you know, the Biden administration is very cognizant of that, and you know, they don't want to see a derailment of the economy or a soft landing to become a recession. So you know, I'm assuming that the Biden administration, through back channels, is working very hard to try to get the two sides together.
Leah, I know you also cover the stock of FedEx. So what kind of upside would FedEx perhaps see if there were a strike, or maybe even if there's not a strike? I just want to hedge my bets here and switch my cargo from UPS to FedEx.
Yeah, so we all knew this negotiation with the Teamsters was coming. So this really isn't new news. You know, FedEx kind of went out to the marketplace and said, you know, if you think you're going to need us, you better come to us sooner than later. Last month on their earnings call, their CMO on the call talked about the fact that, you know, while they're not winning a lot of share as of right now, it's opening a lot of doors to have new conversations with customers they might have not talked to. I think net, it's going to be a positive for FedEx. You know, you're not going to see their volumes jump 10%, you know, this quarter because of the strike. Again, assuming that it's not a prolonged strike, because, you know, FedEx doesn't have like gobs of excess capacity. They're not just going to take anything that comes. They have to be very choosy about making sure that the freight that they do accept into their network is highly profitable freight for them.
You touched a little bit on what the potential impacts could be, but what sort of like rippling effects when it comes to package deliveries and things like this could end up happening if a deal isn't reached?
Yeah, so so if you're a shipper, either your stuff is just going to get delayed, and you're just going to like, okay, I'm going to wait through this. UPS has said, at least there were press reports that they've said that they can handle 4 million packages a day. They do around 20. So and we're talking about their domestic business. So we're talking about 20% of their overall volumes. You're also going to have people that might be crossing the picket line. So call that 5 million. So there's 15 million packages a day that are either going to be delayed or lost. There's estimates out there that about a third of that 15 million might be lost for good, meaning that it might need to find different routes. That can go through the U.S. Postal Service, it can go through FedEx, it can go through, there's a lot of regional parcel carriers, and it also could benefit truckload and less than truckload carriers because they might be shipping things closer to distribution areas and then handing it off to whether the post office or local final mile delivery companies. So, a disruption would be a benefit to a lot of transportation companies that we cover, whether it's, the LTL space like an XPO or an Old Dominion, or a truckload space like the Knight Swifts of the world, and even the brokers, because, if you're a shipper and you're getting desperate to get your freight from point A to point B, you're going to find all your, try to find all your channels. So a C.H. Robinson or RXO might benefit from that. And again, we're not talking about like there's all going to be like a huge jump in volume gains. It should be like an incremental positive.
All right, Lee, great stuff. As always, Lee Klaskow, Senior Transportation Analyst for Bloomberg Intelligence. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
Paul, LeBron James's oldest son is in the hospital. He suffered a cardiac arrest on the basketball court. A statement from James and his wife Savannah says 18-year-old LeBron James Jr., better known as Bronny, was practicing yesterday at the University of Southern California when he collapsed and was taken to intensive care. The statement says Bronny is now in stable condition and out of the ICU. Bronny James is a four-star recruit at USC. He's sent to enter this fall as a freshman after turning down offers from Oregon and Ohio State. Florida Governor Ron DeSantis was in a car crash this morning, but his campaign says no one on his team was hurt. A spokesman put out a statement saying it happened on the way to an event in Chattanooga, Tennessee. The governor was scheduled for a number of fundraisers in the state today. He is running second in most GOP primary polls. House Speaker Kevin McCarthy is making his strongest comments yet about Republican investigations into President Biden's family. In an interview with Fox News host Sean Hannity last night, McCarthy said the probes on Capitol Hill are rising to the level of impeachment inquiry,
which provides Congress the strongest power to get the rest of the knowledge and information needed.
Speaker McCarthy didn't give a timeline or suggest specific charges against the president. The White House is accusing Republicans of trying to taint the president with unsubstantiated allegations. Today, President Biden will enshrine a national monument to Emmett Till, preserving the sites linked to the 1955 lynching that galvanized the civil rights movement. The White House is also proposing new rules aimed at boosting insurance coverage for mental health. A firefighting plane crashed in Greece today as more than 100 wildfires continue to rage. State television showed the explosion after the plane disappeared into a ravine on the island of Evia. Temperatures in Greece are set to reach 118 degrees by tomorrow as Europe's heat wave moves down south. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. This on a day when the major averages all on the green right now. Investors waiting for big tech company earnings after the close and the Fed's interest rate decision tomorrow. Alphabet and Microsoft will deliver more clarity on the cloud business and the ongoing impact and use of AI. Dow Jones Industrial Average on an 11-session winning streak. This is the best run for the Dow in, more than 6 years. Meantime, Andrew Sheets said, did you have something to say, Jess?
2017.
Okay, all right. Meantime, Andrew Sheets at Morgan Stanley is looking beyond the U.S. for opportunities.
Some equity markets outside of the U.S. look more attractive to us. Japan, a number of markets in emerging markets where we haven't seen as much re-rating, where we think earnings actually fell a lot last year, and so the bar is easier for those markets to see earnings growth looking ahead.
Home prices increasing for the fourth consecutive month in May. This is according to the S&P Case-Shiller Index out this morning. Home prices rising, so is consumer confidence. The Conference Board saying consumer sentiment reached a 2-year high earlier this month. S&P 500, 13 points higher. That's up 0.3%. Dow Jones Industrial Average up 52 points. That's up 0.2. The Nasdaq 100, 117 points higher, 0.75% higher. A bit of a surprise this morning with the GM earnings. Mary Barra, the CEO, saying that the all-new Bolt model, there are plans to continue making the Bolt. Really? And we thought it was toast because they had fires and recalls, but the Bolt lives on.
Where's Matt Miller when you need him to comment about
I can't see Matt Miller ever getting near a GM.
He's waiting for his Dodge Challenger with Scat Pack. I don't know what the heck.
It's like how Paul refuses to have an F-150 in
What
his
did you say
driveway.
about the naturally aspirated, 4-barrel carburetor or whatever? Anyway, that is your Bloomberg Business Flash, Paul and Jess.
JT, always appreciate the market updates. And to your point, Dow, longest winning streak since 2017 would be 12 consecutive days with today's session. I want to move over to our next guest who's in studio with Paul and myself, Scott Caraher, who's head of senior loans at Nuveen, who's joining us to discuss the loan activity in the U.S. and the credit quality among businesses as well as banks. Talk to us about how big the loan asset class is, because I think it's something around $1.5 trillion when it comes to assets. It's actually larger than high yield and private credit. And I don't think a lot of people actually know what's happening in that space right now.
That's correct. It's interesting that this is a market that has really grown over the last 10 years. And if you think about what the loan market, the broadly syndicated loan market really is, it's where U.S. companies that are not investment grade go to get financing. And one of the things that investors don't really understand about this market is if you're investing in this market, you're really buying a broad swath of the U.S. economy, right? If you think about a lot of the loans that are in our portfolios are things you and I touch every day, things like Uber, Burger King, Caesars Entertainment, ADT, if you put in contacts every day, Bosch and Loam. And so, these are loans that are, in many cases, public companies, large, leading market shares. And the other thing that I don't think people really understand about the loan market is there are two very unique qualities that don't exist in other parts of fixed income, and that is they have no duration, right? And so as the Fed has been raising rates, it has had no impact on the price of loans, because as the Fed raises rates, the overall yield or coupon on loans steps up. And the other unique aspect of the loan market is that these loans that we're making to these companies are first in line to be repaid. And so if something goes wrong, we get paid back first, just like the mortgage on your house. If you choose not to pay back the mortgage and the bank comes to get your house, well, they are going to pay themselves off first to protect themselves. And so those very unique factors in the market have really allowed for very good volatility in return streams over long periods of time.
So Jess, I was fortunate enough to receive some of the best credit training on Wall Street, and that was the Chase Manhattan Bank
There you
credit
go.
training program back in the day, one Chase Manhattan Plaza. So I can handle my own there, and I'll lend you up to 6 times cash flow. How about that? You're a good customer. Scott, what sectors do you guys like right now in the senior loan market?
Sure. So what we've really been focused on over the last 2 years is, one, going back 24 months when inflation was a big problem, right? And really trying to avoid sectors and subsectors that were going to hit the profitability of certain companies and industries, i.e. Industrials, food, things like that, where companies were going to get squeezed. And now on the flip side, as we've seen inflation really start to abate and come down, and a number of those companies, the price of those loans traded down because of the rise in inflation and the hit to earnings, really focusing on companies and industries where inflation has flipped from a headwind to a tailwind. So think about things like industrial, food, manufacturing, companies like that, where we're really seeing a nice uplift to earnings. But not only that, in many cases, we've been able to buy loans at a discount because, again, our market trades. That's the other thing I don't think people understand. Our market trades every single day. We have transparency on the price of our loans. So we can go in, if a company misses numbers, if there are operational issues and a loan trades down 5, 10, 15 points, we can go in and buy and sell those loans every single day. And so what we were doing going back 8 to 12 months, as we saw the inflection, as we anticipated numbers starting to get better, able to buy loans in the high 80s, low 90s with very nice yields in the double digits. And as inflation has come down and earnings has inflected, we've really been able to find some opportunities that have traded up very nicely.
So then why don't retail investors have exposure to that space? Is it just something that's maybe not as sexy of a maybe asset class as when you're thinking about some of these high flyers in the stock market?
Yes, it's a great question, and candidly, it's a little bit of a head scratcher as to why. I think one of the reasons is irregular investors cannot go buy an individual loan. They have to buy a mutual fund or an ETF. And so what I think has happened is in the institutional space, what we've seen over the last 10 years is institutional pension funds, endowments, they've doubled their exposure to the loan market. It's gone from just over $200 billion to over $400 billion. Retail investors, on the other hand, their exposure to the loan market has essentially flatlined. And so retail investors only own about 6% of the loan market. And in my opinion, and maybe I'm a little bit biased, but if you think about what it offers, floating rate, zero correlation to the Barclays Ag, very low volatility. Yes. Yes. And so there's zero correlation to that ag, right? And it's outperformed that index by over 20% over the last 2 years. But all of the return and volatility characteristics are something that we think is incredibly important for retail investors to understand and appreciate and add to their portfolios, just like institutional investors have recognized and allocated to over the last 10 years.
Scott, got about 30 seconds left. Private credit has been a big market. We've seen so much money flow to the private credit business. How does that impact your business?
It has not impacted it really to any large degree. Private credit has certainly...
Do they syndicate their loans out to you guys?
No.
Generally, no. They hold.
No. So private credit will put those loans on their balance sheets and hold those until maturity. There's also those loans don't trade.
Yep.
And so the public market and the private market are really learning to coexist. There's a lot of important and attractive characteristics of the private market, just like there are in the public markets, and they're very much complementary. So what you're going to see going forward is the public market and the private market really coexisting and offering unique characteristics that we think investors will recognize and allocate both to private and to public credit.
Great stuff, Scott. Thanks very much for coming in here. Really appreciate it. Scott Carraher, head of senior loans at Nuveen, an asset class that we don't talk about enough, but it's a business near and dear to my heart. Love the old credit analyst. Credit's hard and equity's soft. I heard that a number of times. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul's sweeping cost-cutting measures fueled better-than-expected earnings and cash flow for 3M. The company's profit topped Wall Street estimates in the second quarter. Shares are now up more than 5.5%. Bloomberg's Abigail Doolittle has more.
They beat revenue by about 6%. They beat adjusted earnings by 25%. Organic sales declined 2.2%, much better than the expectation of a decline of 4.5%.
Thanks, Abby. After the bell today, it's all about Microsoft and Alphabet. Microsoft sales growth is expected to remain below 10% in the fourth quarter due to slowing demand of its cloud services. It would mark the third straight period of sluggish increases. Shares of Microsoft are currently up more than 1%. Investors will also keep a close eye on Google parent Alphabet's second quarter earnings, especially on how the company's core search ad business will handle competition from rivals like Microsoft and OpenAI that use artificial intelligence. Analysts predict search revenue will increase about 3.7%. Alphabet shares are little changed at this hour. It's the popular three-note sound that's become synonymous with Duracell. Now the slam tone has been registered as a trademark. The Trial and Trademark Appeal Board says it qualifies as a display associated with the batteries rather than, quote, mere advertising. In other words, just like a written catchphrase, the sound is being used to attract attention and spark sales. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets with Paul Sweeney. Coming up right after this, you're listening to Bloomberg Radio.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Met and Paul Sweeney here in the Bloomberg Interactive Broker Studio looking at these markets here. A little bit of green on the screen. The S&P 500 up 0.3%. NASDAQ kind of leading the way here, up 0.6% here. Lots of earnings this week. A lot of big tech earnings after the close, notably Microsoft and Google. And we'll keep an eye on that for post-close. Carol Masser and Matt Miller will have all that as it breaks. Yields up just slightly here. 10-year Treasury up about 2 basis points, 3.88%. We'll keep an eye on that. Right now, let's get a Bloomberg Business Flash with World and National News with Nathan Hager.
Red headline just crossed the Bloomberg terminal, Paul Sweeney. Teamsters Union agrees to contract with UPS. This appears to avert the possibility of a strike that threatened to snarl the U.S. supply chain in time for the summer. The International Brotherhood of Teamsters announced the tentative deal on Twitter, saying, quote, "We've changed the game." Today, the Teamsters reached the, quote, "most historic tentative agreement for workers in the history of UPS, protecting and rewarding more than 340,000 UPS Teamsters nationwide." Again, Teamsters Union says it has agreed to a tentative contract with the United Parcel Service. More to come on Bloomberg Radio. House Speaker Kevin McCarthy says the investigations on Capitol Hill into President Biden's family are rising to the level of impeachment inquiry. It is the strongest signal yet that Republicans could move to bring charges against the president.
Use the weaponization of government to benefit his family and deny Congress the ability to have the oversight.
Speaker McCarthy made those comments last night in an interview with Fox News host Sean Hannity. The Washington Post reports Democratic National Committee Chair Jamie Harrison put out a statement calling McCarthy's comments a political stunt. Today, President Biden is confronting a brutal moment in American history, enshrining a national monument to Emmett Till. Bloomberg's Jody Schneider has more from Washington.
President Biden will sign a proclamation to essentially protect sites connected to the 1955 killing of Till, and also to really mark and highlight the efforts of his mother to highlight his death.
Bloomberg's Jody Schneider reports the signing comes on what would have been Emmett Till's 82nd birthday. LeBron James's oldest son is in the hospital after suffering a cardiac arrest on the basketball court. James and his wife Savannah put out a statement saying their son Bronny was practicing yesterday at the University of Southern California, where the 18-year-old is a four-star recruit. He was taken to intensive care, but the James family now says their son is stable and out of the ICU. Boston Celtics star Jaylen Brown has agreed to terms on a 5-year Supermax contract extension that will pay him up to $304 million. That's according to his agent. This is the richest contract in NBA history, surpassing the deal signed by Nuggets center Nikola Jokic last summer, worth $264 million. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager. This is Bloomberg. Paul and Jess.
Yeah, Paul, I mean, if you're looking over at what's happening with what Nathan was just talking about with this UPS tentative agreement with Teamsters as far as what's going to happen there, and that we're obviously coming up against that August 1st deadline. Yep. We just had Ali Glasgow over at Bloomberg Intelligence walking us through what the potential repercussions could be, but now getting this news, looking at the stock when it comes to UPS, that ticker symbol, not surprisingly, also UPS is up about 2% right now. And looking at its stock, though, year to date, it's still up about 8%, but you want to compare that to its competitor FedEx, ticker symbol FDX. That's up about 50% there. So two very different business models when you're thinking about that. But UPS pushed back its earnings date to actually August 8th because of these issues that were going on in recent weeks when it came to this potential strike.
Yeah, UPS, it's a contract with 340,000 unionized workers. So, a lot of folks out there now have some security there, and it's good for presumably both sides just avoiding a strike, which would have hampered the economy to some degree if it had, kind of drifted past a week, as Lee Glasgow was saying, that, really would have repercussions. You think about the supply chain, which is just, kind of getting back to a more normalized state. You'd hate to see something interrupt that. So good news for labor, good news for UPS, and good news for the economy. We're going to have more news coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Of the leaders of the Writers Guild of America, they're on strike against Hollywood. This is a big deal. So they have the writers on strike. Now you've got the actors on strike. Really, really big issue for the media sector. We'll get the lead on that. Plus, Karen Ubelhardt, she's a senior analyst at Bloomberg Intelligence. She covers all the industrial companies. We got General Electric reporting here, so that's a key company. We'll get a preview there. Plus, we're going to check in with the CEO of Lifetime Group Holdings. Talk about the gym-going business here in a kind of a post-pandemic world. Are people heading back to the gym? So we'll get the latest there. But let's kick things off here with Denise Pellegrini with a Bloomberg Business.
Yeah, it's 12:01 on Wall Street, Paul. We check the markets all day long for you here at Bloomberg, and somebody not going on strike, apparently the drivers at UPS. The Teamsters Union, as we've been reporting, has agreed to a tentative contract with UPS. Of course, there could have been a lot of problems, as you've been talking about, with supply chains. If that had actually happened, you're talking about more than 300,000 workers. So that would have been really pretty awful, for all the shipping industry. But that maybe is not going to be a problem. It's also helping UPS stock right now. It's up, let's just about 0.5% right now. We also have some headlines on more economic strength crossing the Bloomberg terminal just as Fed members walked into that FOMC meeting. U.S. consumer confidence advancing in July. That's from the Conference Board. Also, the IMF lifted its world growth outlook. U.S. stability, GDP among the things it was positive about, but also a little bit of a qualifier from the IMF citing higher rates, persistent inflation, and sluggish China among the dangers. And Drew Mattis, chief market strategist at MetLife Investment, is among those who think recession is, going to hit us.
The good news is there's not going to be a recession this year. The bad news is it's still coming. We've had to move back our forecast from mid-year to the start of next year. The reason we went that far, actually, is because we think consumers are still in this ball game. They're still in this you only live once mentality post-COVID. But we do think when you get to the start of next year, you'll have a lot of more headwinds. And some of the data now that's currently pointing towards a recession will probably be even worse. And we think the turn of the year is about the right time.
Yeah, you heard that call here on Bloomberg Radio. Mattis there on Bloomberg Surveillance podcast. Investors probably focused a little bit on those possible rate hikes. And on that recession, the Dow right now, though, it is higher, green across the screen. The Dow up 67 points. The S&P 500 up 12. The NASDAQ up just about 82. The yield on the 10-year right now, 3.89%. Spot gold, it has been higher all day, up about 0.5% right now. And crude oil right now, it is also higher. So you might call it a little bit of a mini rally for crude because we saw that big jump up yesterday. Biogen shares down almost 4%. They're cutting about 1,000 jobs. Revenue coming in a little bit stronger than expected. And 3M shares up almost 6%. Company topped Wall Street estimates, driving a rise in the annual outlook. And that is a Bloomberg Business Flash. Back over to you guys.
All right, Denise Pellegrini, thank you so much. We appreciate that. Jess Mint, Paul Sweeney here in the Bloomberg Interactive Broker Studio. And, of course, we are streaming live on YouTube. You can head over to YouTube and search Bloomberg Global News, and that's where you'll find us. And, Jess, I don't know about you, but I'm just sick and tired of this recession call. There's going to be a recession at some point since the beginning of time, but we've been talking about this for 18 months.
Right, and they continue to get pushed back. And then if you talk to people, say like Gina Martin-Adams over at Bloomberg Intelligence, talking about how the stock market is a forward-looking indicator, clearly seeing better times ahead, and especially when you're looking at corporate profits into earnings season, even though it's supposed to be the steepest in the decline. If you look at earnings, excluding energy in the S&P 500, signaling better times ahead in the second half of the year.
Yeah, it's just you keep hearing these economists saying, oh, we have to push it back, push it back. Well, of course you have to push it back. I mean, I don't get it. Let's talk to an expert here on the stock market here, because we've got green on the screen here. The S&P up by 0.25%. Bailey Lipschultz joins us here in our Bloomberg Interactive Broker Studio. He covers all the markets for us. Bailey, what are you looking at today on a busy earnings day?
Yeah, a lot moving to the up and downside. Best performer in the S&P 500 is Packaging Corp of America.
Nice.
They make container board and some of those products that are basically turned into boxes. That stock right now up double digits and leading to peers outperforming on the day. Just wanted to call out very briefly, as you mentioned, that UPS news, FedEx actually down 0.8%, and UPS giving back the bulk of those gains. So obviously something to keep an eye on.
You know, I once made a private investment in a packaging company that made corrugated boxes. Didn't make a nickel. I was at probably 10 years before this whole e-commerce thing just exploded. I mean, I had the right idea. I was just off by a decade.
How frustrated were you, Paul?
You know, we couldn't give the company away at the end. Anyway, and the stock's up 10%. It's up 20% year to date. Good for them.
Yeah, and then leading to strength in peers, including International Paper, WestRock, and Crown Holdings, though many of these stocks are actually trading lower on a 12-month basis, so underperforming kind of in the grand scheme of thing. Another company that did have results over in Europe, LVMH, beating expectations on the top line, but when you look in a little bit, the ADRs trading under LVMUY, bit of a mouthful, down 3%. Looking into the release, though, signs showing that demand for luxury goods actually slowing here in the U.S., economic recovery in China, maybe a bit lumpier than many were expecting. So we saw that actually showing up in a bit of weakness for some U.S. companies. Looking at Capri Holdings, ticker CPRI right now, down about 1.3%. So bit of uncertainty around some of those luxury spending trends as we continue to deal with that.
What we haven't seen, or I haven't seen in New York, is the Chinese tourists back on, like Fifth Avenue and Madison Avenue, because you used to see that, and I know that's why, those retailers love, because the Chinese are such strong consumers of the luxury products. And then they're just, they've reopened, but I haven't, from what I understand, they haven't necessarily come back as tourists to New York and other places.
Yeah, no, I mean, at least just man on the street reporting,
I would say that
I haven't seen, I would say
the
that
Europeans are back in mass, and America's basically taken over Europe this summer with all the tourism over there. So but we just need to get the Chinese to start traveling again.
To switch back. I mean, talking about traveling trends, Alaska Air right now down 12%, leading peers to trade lower. You're looking at Southwest down 5.8%, United Airlines down 4.6%. Again, we talked about this earlier, CFO warning of pressure from falling ticket prices. So uncertainty around whether consumers not only here in the U.S., but maybe overseas, wanting to spend big on travel through the rest of the year. Again, this is a group, broadly speaking, that has been one of the best performers so far year to date. You look at a stock like United Airlines, still up 42%, even though they're down almost 5% today. So still one of the better outperformers alongside some of those big tech names, which we obviously will be getting results from a handful, including Microsoft and Alphabet after the bell today.
Yeah, if you look at those passenger airlines in the S&P 500 this year, up about 25%, so really helping the discretionary sector out, as well as those home builder stocks.
I'm not flying unless somebody pays me to fly. That's the new strategy here. All right, Bailey, thanks so much for joining us. Bailey Lipschultz, he covers all the markets for Bloomberg News, joins us here in our Bloomberg Interactive Broker Studio. I'll tell you what, it is very difficult to be a media investor these days. I follow this sector for more than 30 years. Today's is as tough as it's ever been. You've got this whole business model evolution, or switching from the core cable TV model now to the streaming model. You don't know where those economics are going, and now you've got a couple of strikes in the industry, one with the writers, another with the actors. We want to get kind of the latest on what's going on there and what's really some of the fundamental issues here. And we're joined by Lisa Takeuchi Cullen, Vice President of Film, TV, and Streaming for the Writers Guild of America East. So I'm guessing that's kind of a New York thing. Lisa, thanks so much for joining us. From the writer's perspective, can you kind of just frame out for us what your issues are with the industry, or what the issues are with the media companies?
Sure. Our main issue is compensation, as is the issue for, I think, a lot of workers across America today. Our compensation has been eroding in a time of what people consider peak entertainment, peak television, peak film. There are record numbers of people going to see these things and watching them on streaming at home. and record profits, record revenues, while meanwhile the people who create the content have been making less and less. TV writers in particular are making, adjusted for inflation, about 25% less than they were 10 years ago. And this is a time when television has been exploding as a medium and as companies have been raking in the revenues and profits. So all we're asking for, really, just like the actors, just like the crew, just like the Teamsters, is our fair share of the product that we create.
And what specifically are you, when it comes to the writers, are they looking for to get back to work? What are the demands right now?
The demands are that the studios meet our proposals and actually engage in negotiation on them. Our proposals remain exactly what they were when we began the strike on May 1st. And
can you summarize kind of what they are, the main proposals?
Sure. The main one is a raise in our minimum rates. The contract that we work under is called the Minimum Basic Agreement, and essentially it outlines what the minimum rates can be for film and TV writing in our industry. And we are trying to negotiate a hike in those rates because, adjusting again for the spike in inflation, writers are making far less than they were, to a point that it is simply not sustainable. We have members who cannot make the rent, who are on actual food stamps. People don't think of that when they think of Hollywood. They think that life is glamorous and that we're all rich and we own yachts and private jets. And most of our working people are middle class, if that. Now most of them are struggling to maintain a toehold in the middle class. So it is raising our minimum rates. It is adjusting residuals for this age of streaming. That is a huge issue for both the writers and the actors. We are not seeing anywhere close to the residuals that kept us afloat for decades, back in the days when the model was not broken. But all of the studios jumped on the streaming bandwagon, and now here we are with this broken system where none of us are being compensated in a way that allows us to live. We're also fighting for some sustainability in our careers in both film and television. We have seen our ability to manage our work and to create with our own creative license erode. TV writers are no longer allowed on sets if they're working on streaming shows because of the long delay in between a writer's room and when the actual production occurs. We're fighting for growth in the size of a writer's room, which is the room that convenes before a television show is made in order for writers to come up with a plot and to write all of the episodes. The rooms are becoming smaller and smaller as the streaming budgets for writing shrink. And I say for writing because streaming budgets for shows and movies have exploded. Studios are spending, $19 billion a year on actually making these shows and movies, but the slice of the pie that writers are getting is getting smaller and smaller. So we're fighting for all of those things.
Lisa, I've covered the media industry as a financial analyst for more than 30 years, and I've never seen an industry that has so much uncertainty in the core business model. If I were an executive at a media company, my response might be, our model is broken, and we don't know what the profitability of streaming is. We don't know how people are going to consume media going forward. We're trying to adapt from what you mentioned correctly before, which is, the traditional model that we all grew up with, whether it was supported by cable subscriptions and 100 million households paying money every month. That model's pretty much gone away. Now we're trying to replace it with the streaming model, but the economics are uncertain. Is that an argument that resonates with you guys at all?
No, that's not our problem, right? I'm not the CEO of the company. I'm not the one who chose to enter into a major merger with another company or takeover of another company that placed my company into a great amount of debt. So now I'm not able to pay my bills. The companies are still making profits hand over fist. They are still raking in, what is it now? I think $30 billion in profits from entertainment alone. And I'm not talking about Amazon's packaging business or Apple's computer business. From the studio companies, from the profits that they make just off of the product that we create, they're making $30 billion in profits a year. So they're the ones who have to lie in the bed that they made. But it doesn't excuse them from having to pay their labor fairly, right?
How has the rise of streaming affected writers' compensation?
it has decimated writers' compensation. Streaming has changed the way that we work. It used to be that under the network broadcast model, that writers could be employed 40, 45, 50 weeks a year because the television shows would run for 20 episodes, 22 episodes, 23. And the rooms would convene in the early summer, and they would run through the spring, and then there would be a short break in between. Not only would we make the weekly pay that would sustain a middle-class lifestyle, we also would make residuals, meaning that when those shows were rebroadcast in foreign markets or on cable television, we would receive checks in the off times that perhaps we were not working on a show or perhaps we're on a hiatus that would pay our bills and continue to sustain a decent lifestyle. All of that has gone away. Streaming has introduced the idea of what's called a mini room, which is a studio concept that is mini in every way, mini in size, mini in duration, mini in pay. And that means you gather together a very small number of writers and you pay them at the minimum rate allowed in our contract to produce 10 episodes. And I say produce, meaning write. They're not actually producing it because, again, the production occurs much later, but they're writing, say, 10 episodes of television in 10 weeks. And then they're sent off to, to try to fend for themselves for the rest of the year. And that is simply not sustainable.
Lisa, how far apart, based upon your understanding, how far apart is the union and the industry? And second, how long is the union prepared to stay out?
Sure. So as an officer of the Guild, I have been involved in the negotiations from the start, and I will say that the studios simply refuse to even engage with us on our core issues. So I would say we're still far apart until they come back to us and say, okay, we hear you on your core issues. This is our counter offer, and then we can come back with another counter offer. That's what a negotiation is, and they have refused to even negotiate on those points. So we do need to get there. As far as how long we are willing to stay out, I talk to membership every single day, as do the other officers and the other members of the negotiating committee and the other elected officials. And our unity is strong, our solidarity is strong. Now that we have had 160,000 reinforcements when SAG-AFTRA joined us on the line, the feeling is that we have to get what we came for. We have to get what we came for, or else it is absolutely an existential crisis for us. The career of writing for Hollywood will no longer exist. So I believe that we are willing to do what it takes.
All right, Lisa, thank you very much for taking the time. Really appreciate it. I know it's a contentious issue on both sides, and hopefully both sides can come to an agreement sooner rather than later. A lot of jobs at stake, and a lot of folks are depending upon it. So Lisa Takeuchi-Cullen, Vice President of Film, Television, and Streaming for the Writers Guild of America East, giving us the latest on those negotiations. And Jess, unfortunately, as Lisa was pointing out, it seems like they're still quite far apart.
Yeah, with both sides digging in their heels, the strike could last a while, and uncertainty there is about basically how long.
Yeah, and you think about the fall season, such as it still is. You think about movies that need to be made and all that type of stuff, hopefully sooner rather than later. This is Bloomberg. Let's get some company news right now. Steve Rappaport.
Paul, you were just talking about Hollywood strikes. Now let's go to a potential strike that might have been averted. The UPS strike. The Teamsters Union says it has reached a tentative agreement with the company. It says the 5-year contract raises wages for all workers, creates full-time jobs, and includes dozens of workplace protections. In a Twitter post, the union said it is, quote, the most historic tentative agreement for workers in the history of UPS. They were running short on time to get a deal done. The current contract expires at the end of this month. Shares of UPS right now up less than 1%. General Motors raised its profit target for the year by at least $1 billion amid demand for its gas and diesel-fueled SUVs and trucks. Second quarter earnings beat analyst estimates on stronger than expected U.S. sales. CFO Paul Jacobson tells Bloomberg TV the company isn't sure that they'll be able to raise prices across the board.
We see a lot of stability in the market. We're just kind of taking it one day, 1 month at a time, and watching the results come in. We've got to be focused on quality, and we've got to be focused on getting production in the vehicles that customers want.
Jacobson also said that higher interest rates aren't stopping consumers from taking on loans. GM has written loans at a higher share in the first half of the year than traditionally, using high-quality borrowers. And shares of iRobot down more than 12% after Amazon said it's paying less to acquire the Roomba maker. That's about 15% less than its original offer. The price change is to account for $200 million in fresh financing taken out by the company to fund ongoing operations. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 12:21 on Wall Street. We check the markets for you all day long here at Bloomberg. Stocks are higher. The Teamsters Union, as we've been reporting, has agreed to a tentative contract with the UPS. More than 300,000 workers represented there. Huge strike potentially averted. That appears to be bullish, at least for the stock. It is trading higher this hour. It's been higher since that news broke. Headlines, meantime, on more economic strength, also crossing the Bloomberg terminal, just as those Fed members walk into that FOMC meeting today, right? U.S. consumer confidence advancing in July to a two-year high, bolstered by a strong job market and also easing inflation. Conference Board's index rose almost 7 points to 117 in July. Also, the IMF outlook is improving. We'll be talking more on that in just a little bit, but it sees GDP and world growth outlook expanding, so it's lifted both those forecasts. And we'll be watching for the tone of what the Fed has to say with our live special coverage here on Bloomberg Radio tomorrow, particularly what they say about the future. Right now, the Dow is higher by 65 points, the S&P 500 up 13, the NASDAQ up 88. The yield on the 10-year right now, it is 3.89% now. And spot gold, it is trading higher, up just fractionally. And NYMEX crude, it's higher again today. And that is a Bloomberg Business Flash. Back over to you guys.
All right, Denise, thank you so much. We appreciate it. Jess Menton and Paul Sweeney here in our Bloomberg Interactive Broker Studio and streaming on YouTube. Just head over to YouTube and search Bloomberg Global News, and you'll find us there. All right, Jess, here's our next guest. Here's a who's who of some of the top names on Wall Street. Salomon Brothers, Oppenheimer, Goldman Sachs, Government of Singapore, as we kids call them,
one after
GIC,
the other.
Lehman Brothers, and now for the last, 13, 14 years, Bloomberg Intelligence.
That's quite the CV.
Top machinery analyst on Wall Street, bar none.
She knows it.
Karen Ubelhard, she's here in our Bloomberg Interactive Broker Studio. She's been covering machinery and all that kind of industrial stuff that we make for a long time.
Telltale signs of the economy.
Exactly right. Karen, thanks for joining us here. Let's talk about a company that we don't talk about enough, but it's one of Tom Keene's favorites, Minnesota Mining and Manufacturing, 3M. They had some good numbers today.
Yeah, they they have a big consumer exposure, so their organic growth was actually down, but down less than expected, and they delivered on the margin side. They've done a huge restructuring. It seems to be gaining some traction, and also expectations are so low for 3M now since they've had a lot of problems, particularly the litigation problems. So,
but boy, they're in everything: safety and industrial, transportation, electronics, healthcare, consumer. This is a conglomerate, right?
Yeah.
Yeah.
I mean, they make everything from the Post-its to grinding wheels. I mean, they literally are GDP.
I mean, looking at that stock, ticker symbol MMM, up about 5%, so on pace for its best day since the beginning of June. You look at its stock, though, year to date, down close to 9%. What's the story there?
They have a tens of billions of dollars litigation problem for environmental. It's PFAS is the name of the chemical that has been hurting water. And so that could be $25 billion. They've got another one on earplugs for the military. So they've got a lingering 30 billion, 40 billion plus litigation that potentially they would have to pay over a long period of time. That's the biggest problem. And then they've also disappointed on, performance, on operating. But we've had 2 quarters now where they beat on revenue and they beat a lot on earnings. So I think the reason it's up is people are saying, oh, is it coming together on the operating side?
St. Paul, Minnesota, the home. Great town. I love St. Paul.
Yeah.
All right, great hotel. I can't remember the name of it, but that's where you always stay when you go to marketing in St. Paul. All right, let's go to GE. What is GE today? Tell us what they own, because all I remember, it's been an investment banker's dream just selling off businesses left and right. So I'm not sure what's left. And then what do you expect from their earnings?
When I started covering, they were in 8 businesses. They're now in 3, and they're about to be in 1.
Really? Wow.
What's left is aerospace. That will be a standalone company. And then and what they're calling an energy company, and it's basically renewables and their big power business, the turbines, the big turbines. That's what's left. Those are going to go together, and aerospace is going to stand alone. That's what's left.
Really? So the GE will just be
a pure play.
Okay.
Aerospace.
All right. So talk to us about kind of what's left and how's it performing, and they're going to be reporting earnings. What are we looking for?
They actually did report this morning, and they beat by a lot. That's why the stock's up. And aerospace is through the roof. And people, you estimate 20% growth. It was up 28%. It's just exploding on both the OE side and also on the commercial aftermarket side.
Yeah, looking at that stock, I mean, up 6% this morning, and then year to date up 80%, trading around multi-year highs.
You've been waiting a decade plus for this.
A while for that. But the other thing is their other side, the Vernova piece, has really struggled largely because of the renewable business. And that came together nicely, today as well, with huge orders, like a tripling of orders. And the losses were much less than expected because the volumes were up so much. The volumes were up 27%, and the street was looking for 5%. So that business is the one that's been, hanging around their neck, that can they fix it? Can it be a good business? I'm not sure it can be a good business, but it's a lot better business than we thought, and that's what's really going on.
So talk to us about this turnaround for GE after it was kicked out of the Dow in 2018.
They particularly in their power business just fell out of bed, and they had way too much capacity for the large turbines, that generate electricity. We don't use them anymore. The stuff that's there will still be, the installed base is still good, but the growth rate of that market and the size of that market has been cut in half. Then you've got a wind business that they've lost money in for a long period of time. So you had a lot of lingering problems, and the finance sub was a real problem for them, and they basically got out of the credit sub, and there are a lot of write-offs related to that. So it felt like they couldn't get out of their own way for a couple of years, actually.
There's nobody better to ask this question, which is, because you've known this company forever, what do you think today, with hindsight, the legacy of Jack Welch is?
I have said, and I said this a while back, that someday they're gonna, they wrote the book, The House That Jack Built. Yep. Someday they're gonna write the book, The Straw House That Jack Built. And I hope I don't get in trouble for that.
Because, there was a time when he was building up General Electric, mainly through acquisitions, presumably, you know, kind of that conglomerate model, trying to find businesses with great returns and all that kind of stuff, and just building them up. And then GE owned everything from NBC Universal to turbine engines. And
light bulbs.
Light bulbs, exactly. I mean, and that was the conglomerates. That was a real business strategy for decades in this country. Jack Welch, arguably the most prominent proponent of that. Now that's, I think probably the market has been saying for the last 10, 15 years plus, that's not where we want to be.
Well, he grew the finance up to be 50% of GE's earnings. It was very profitable, and they got involved in a lot of financial things that they probably should not have been involved in.
But originally it was set up, oh, you want to buy $100 million piece of equipment for me, I'll help finance it, just like an auto
and that's what it's
dealer
back
would
to.
do. Yeah.
That's what it's very small. They finance like the big turbine equipment, et cetera, but they are out of all that other stuff. But they had to take huge write-offs to get out of that.
The financial crisis.
Yeah.
Right.
And the other thing is he was, if you know, in my opinion, in order to get higher margins every single quarter, you know, he, you know, I think they milked the R&D, and they had to play catch up on that as well. And I think that was another problem. You know, so he really was, you know, the king of industrials for a while, but Immelt was left with a rather large headache.
When you're looking at these earnings results from 3M to GE, what do you think these corporate profits in this particular segment of the S&P 500 tell us about the direction of the economy?
You know, I don't think the economy is as bad as people are anticipating. You know, people are worried about a fallout in the second half. Some markets are slowing, but it's a pretty narrow slowdown. It's certain consumer markets, and more that actually is probably spreading. But the industrial side is really solid. And if you see all the mega projects from onshoring, you know, the infrastructure bill, the IRA, which is why wind is doing so well, all this federal money is just going to prop up industrials, and I don't really see we're going to see an industrial recession.
How about China? I mean, your companies deal with China like nobody's business. So what are they saying?
It's slow. The recovery is slower than expected. 3M actually has a large exposure to China, and they said they're in recovery now, and it was down 8%.
Are they worried? I mean, how are they framing the geopolitical risk around the U.S. and China, or China and the West?
People are, you know, I would say that you're not going to see more dollars spent there because there is some concern about that. It's an important market. It's 5 to 8% of sales for a lot of these companies. They can't pick up and leave, but they are certainly rethinking at least how the business is sized, because we don't know what's going to happen politically, and the recovery just is really taking a while to get going.
So how did they, just 30 seconds, what's kind of the top area that you're looking, what's the hot?
The two hottest areas, aerospace is just on fire.
Right.
And that has a lot of legs. Also, anything climate related, like the HVAC business. Residential HVAC is down, but the rest of the business is strong, and we've got $1 trillion in money, tax credits. It's $300 million in tax credits and $1 trillion when you gross it up of money as a result of the IRA.
Yep. All right, Karen, great stuff. Always appreciate getting your insight. You know, Karen and her companies touch everything in this U.S. economy. It's amazing.
And looking at this industrial sector in the S&P 500 trading around records.
Yeah. Yep, good. A lot of stuff. Everybody wants to talk to Karen Ubehard now. Karen Ubehard, senior analyst, she covers the machinery and all that industrial stuff for Bloomberg Intelligence. Appreciate getting a few minutes. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
And the breaking news of the afternoon, Paul, strike averted at UPS. The Teamsters Union has announced a tentative 5-year labor contract with the shipping giant days before the current deal was due to expire. Bloomberg's Kaylee Lines has the details.
They say this is a historic agreement for workers in the history of UPS, protecting and rewarding more than 340,000 Teamsters worldwide. It includes wage increases. Existing full-time and part-time UPS Teamsters will get $2.75 more per hour in 2023, $7.50 more per hour over the length of their contract. Good news for this company, but also the economy broadly. A lot of people here in Washington have been watching this potential strike because of the economic ramifications it could have, the impact it could have had on the supply chain.
Bloomberg's Kaylee Lines there from Washington, and right now UPS shares are higher by 1.4%. The Hollywood writers and actors strikes continue. Meanwhile, members of the Actors Union SAG-AFTRA rallied this morning in Times Square. Christian Slater addressed the crowd.
Because of SAG, because of real people who work to help our members,
My father was able to die with an amount of dignity that he would not have otherwise had. He lived as long as he did because of SAG.
Christian Slater's father is the late actor Michael Hawkins. The White House is putting a spotlight on a brutal moment in American history. President Biden is speaking right now at a ceremony where he is signing a proclamation establishing a national monument for Emmett Till, the 14-year-old black teen whose lynching in 1955 galvanized the civil rights movement. Vice President Kamala Harris spoke moments ago.
As people who love our country, as patriots, we know that we must remember and teach our full history, even when it is painful, especially when it is painful.
Vice President Kamala Harris speaking moments ago at the White House. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg. Paul and Jess.
All right, Nathan Hager, thank you so much. We appreciate it. Jess, it seems like the labor news is just all over
It is.
the news today. We talked to somebody from the Writers Guild of America East on the strike by the writers and the actors. That's not looking good. But then on the flip side, we had the UPS agreement with their Teamsters.
And then also looking at UPS's stock up actually more than 1%. It briefly paired those gains, but now it's back up about 1.5% on the news that UPS and Teamsters did reach this tentative labor deal to avoid a strike.
Let's bring in Chester Dawson. He's a North American transport team leader at Bloomberg News. Chester, anytime a strike gets settled, you kind of like to think, both sides probably didn't get what they wanted. Neither side's really happy, but boy, it's better than a strike. Can you give us some more details on what the Teamsters and UPS agreed to today?
Yeah, well, first, as you alluded to, it's good news for the market. Obviously, UPS shares are up on it, and it's a win for both the union's new leadership, the Teamsters under Sean O'Brien, and also Carol Tomei of UPS, who had insisted they would get a deal done ahead of the deadline. Now, had it gone right up to the wire, there would have been, a lot of nervous shippers out there. But it looks like a deal that they can both live with. I mean, it is going to cost UPS and could weigh on margins. But we kind of knew that was coming. And for the Teamsters, they got, as you say, half a loaf or maybe a little more than half a loaf. They got some of the wage increases they wanted, air conditioning in some of the newer vehicles, and getting rid of a two-tiered wage system.
Now, the key word here being tentative. When will the deal be finalized?
That's the operative question. It does need to be ratified by the membership, and that vote will take place over a period that starts on August 3rd and wraps up on August 22nd. So we should know shortly thereafter.
And is this, it's interesting. We were talking to Lee Klaskow, who covers the transports for Bloomberg Intelligence, and I kind of framed a question saying, these folks were essential workers during the pandemic. I mean, they didn't stop working. They were delivering boxes every day. Was that part of the discussion or part of the positioning by either side?
Absolutely. I mean, that's something that the Teamsters, mentioned repeatedly, and a card that they, a strong card that they had that they played well. What UPS would, and I guess the important thing to remember about that is that helped UPS achieve record profits.
Yep, good point.
Now, the flip side of that is that as the pandemic waned, demand for that type of shipping service, it didn't evaporate completely, but it has waned a bit. So UPS, their position was, well, we can't, be as generous as we might like because the business has weakened a bit. But yes, that's a very valid point. And, these workers work under 5-year contracts, so they can't, immediately go to the table and say, give us more when the business is great. They need to reach a deal that they can live with over the next 5 years, which hopefully pays them back a bit for, the extra work they put in during the pandemic.
And UPS actually pushed back its earnings date for the second quarter till August 8th because of what was going with these ongoing negotiations. You mentioned that this deal will likely weigh on margins. What are you expecting when it comes to their outlook and how that could potentially impact their earnings projections when we do hear from them in a couple weeks?
Boy, that's a very good question. I don't think we know yet. I think we're still kind of waiting for the details to sink in. UPS hasn't said, anything that indicates, what kind of a hit they may take over, the shorter term period. They have said that the whole deal is $30 billion over 5 years. So yes, I guess smarter people than I are going to have to figure out what that means in terms of their outlook over the next few quarters. But I'm sure there'll be a lot of interest in that on the part of investors.
Chester, are there any repercussions or precedent that this agreement may set for the Teamsters and other discussions?
Well, yes, that's a good point. The Teamsters had hoped to make this kind of a springboard for other negotiations, including with Amazon. So this could be seen as a template or a precursor of sorts. But beyond that, we know that other unions have been paying close attention. For example, the United Auto Workers, which are in some delicate talks with the big three Detroit automakers. So this could have ramifications far beyond just UPS and could be helpful to the Teamsters in their negotiations with other companies.
Just quickly, Chester, just give us a sense, how big are the Teamsters today? Because, I mean, I think back to the Jimmy Hoffa Teamsters, but how big are the Teamsters today, the union?
They have more than 250,000 members. It's about 340,000. So that's a lot, and there will have to be a campaign to win them over. It's going to be a test for their new president, Sean O'Brien, who hopes to show that he can, negotiate a tough deal and walk away with some decent spoils. But ultimately, as you say, it's going to be up to those 340,000 members to decide whether they go for it or not.
Okay. Chester, thanks so much for joining us. Chester Dawson, he is the North American transport team leader at Bloomberg News. All right, let's go to Denise Pellegrini. We want to get a Bloomberg Business Flash right now.
Yeah, it's 12:40 on Wall Street, and of course we check the markets for you all day long here at Bloomberg. And it's amazing, really, when you think about UPS, that a company can say it's going to spend an additional $30 billion, as Chester Dawson just mentioned, and the stock still goes up. It is about 7%, 0.7% rather, higher right now. Just goes to show how important it was for UPS to avoid a strike. Of course, competitors like Amazon, FedEx, and others, they were kind of waiting in the wings, trying to maybe think about stealing some of that market share. So if there's no strike, they won't be able to do that. That may be one of the reasons why the stock's higher. We also had consumer confidence jumping. This is the report from University of Michigan. Consumer confidence advancing in July, Conference Board rather. Consumer confidence advancing in July to a 2-year high, bolstered by a strong job market and also easing inflation. The Conference Board's index rose almost 7 points to 117 in July. The IMF outlook also improved. The IMF lifting its world growth outlook on U.S. stability. GDP this year seen expanding 3%. They had talked about 2.8% in April. That's a boost, but they did cite higher interest rates and persistent inflation as problems. And we'll be watching for the tone of what the Fed has to say with our live special coverage here on Bloomberg Radio tomorrow. Chris Giamamani, CIO at Lafayette College, also longtime market watcher, says he is bullish on stocks. He has an eye on a specific S&P target.
Nominal growth is pretty high, and as long as that is the case, and we are still in a stimulative environment in terms of fiscal policy, I think stocks probably hold their own. They probably don't go to 4,800, 4,900 anytime soon, but I think they can hold this middle of 4,000s range for an extended period of time. I think if rates go meaningfully higher, then everything kind of becomes far more questionable. But at the moment, I don't think that is the case.
And Mamani there on the Bloomberg Surveillance podcast. Stocks are higher. The Dow up 67 points. The S&P 500 up 14. The NASDAQ up 92. COMEX Gold, it's been higher all day, up just about 0.5% right now. Crude oil right now up about 1%. And the yield on the 10-year right now, 3.89, almost 3.9%, let's call it. And that's a Bloomberg Business Flash.
Thank you, Denise. We appreciate it. Jess Minton and Paul Sweeney here in the Bloomberg Interactive Broker Studio. And Paul, we've talked so much about particular industry groups that have really rebounded as things continue to reopen from the pandemic. And one of those, especially when you're looking at what's happening with some of these gym-related stocks, looking at what's happening with Lifetime Group, that's ticker symbol LTH, up close to actually more than 50% this year alone. And who better to join us for our C-suite conversation than Bahram Akradi, Barry, CEO at Lifetime Fitness, who's joining us on Zoom to discuss his company post the pandemic, as well as earnings and the outlook when it comes to consumers as well as gym goers. And you've talked a lot, Bakram, about how when it comes to Lifetime Fitness, this isn't just a gym. It's supposed to be this sort of country club experience. Talk to us about what's been the key to your success, especially when it comes to the reopening that you've had over the past year.
Fantastic. What we focused on from the time we reopened, it was desirability for our customer. We worked on programming. We worked on much more elevated experiences across all aspects of what we offer, whether it's the beach clubs, our food, our spas, our personal training, small group training, our RUP program, all of the different programs. We added pickleball at the sort of an incredible pace. We're up almost 600 courts today. We'll have at least 700 by the end of the year and 1,000 by the end of next year. So we basically have listened to see what the customer wants and offer that at the most experiential level. Everything's working beautifully. We are completely happy with our results. We're right where we expect to be. We are doing this without any promotions, any sales, any salespeople. We're just focused on creating that desirability, and the customer is pouring in. Our results have been never better. We have the best margins. We rewired the company structurally the last year to make sure the decisions are made much more rapidly to satisfy the customer, and that has also generated massive improvement to our margins. So it's all good news.
Bahram, your stock is down 15% today on your earnings. Your sales disappoints. Talk to us about what happened with the latest quarter and kind of what your guidance is here.
That's honestly enigma. We didn't miss anything. The analysts have missed completely. They have tried to listen to our sort of tone about EBITDA, and they tried to get to that EBITDA by lower margins and just pushing the revenue numbers up. Our revenue is exactly where we expect it to be. It's within the range we gave the street. So I have no apologies for anyone. Our team is working their cans off. Everybody's performing. We're super happy with the momentum of the business and where we can take it from here.
Well, it sounds like at the very least you need somebody to manage streets' expectations so you don't have that volatility in the stock. That would just be an aside from a former analyst. Talk to us about what are your growth drivers going forward here as you adjust to kind of a new world where people are getting back out again.
Yeah, actually the clubs are doing fantastic. Many clubs are at the point where we really are putting them on wait list, and then we just basically meter the people in so that we can manage that experience. We have ability to basically create the rack rate where that we can create optimal experiential for the people. We continue to create, invent programming. The most recent one that we are in the guts of getting it rolled out by beginning of fourth quarter is dynamic stretch. We'll have that rolled out to about 150 locations by October 1. So we continually think, invent, reinvent opportunities to serve the customer in all aspects of their healthy living and healthy aging. And so we have many, many other initiatives in the works. So I anticipate double-digit growth for this company, top line, bottom line, for the foreseeable future.
Let's talk about the demographics, because the average membership is over $200 in some key areas per month, and more than 40% of the members are under 35 years old. So I'm curious, when it comes to student loan repayments, how that could potentially impact your business.
Yeah, you know what, honestly, I don't see that being a factor whatsoever. Our memberships are very broad, from very, very young people to very, very old people. We have kids from 90 days old in these clubs with their families, all the way to 80, 90-year-old members. So there, no one segment is going to have an impact in our business in a way that people think, oh my God, the student loan is going to make. We're not seeing anything. In fact, the number one indication to the health of our membership is attrition rates, which, as I mentioned earlier, June was the first month we saw after COVID, that as after reopening, that we had attrition rates below 2019 rates. Now that has followed through with July and August having exactly the same trends. And we take attritions today for September. So we already know the numbers for July and August attritions. So it's all showing complete signs of strength. We're not seeing any weakness in our clubs or our performance. So, and again, the students, those who can be impacted by this, is going to be a small section. Lifetime is so broad in terms of our offering, in terms of our demographic, that I don't think any one sector is going to make a difference. We're us not being able to deliver the numbers we guide the street.
All right, Bahram, thanks so much for joining us. Bahram Akradi, CEO of Lifetime Group Holdings. That is a New York Stock Exchange listed stock. They went public last year, or I'm sorry, 2021 at $18 a share. The symbol's LTH. That's a ticker load into your Bloomberg terminal. S&P 500 up 0.3%. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Poll shares of Spotify are down more than 14% after the company reported more users than expected, but revenue slightly below estimates. And that comes a day after announcing it would raise the price of its U.S. subscriptions. Bloomberg's Lisa Mateo reports.
The music streaming platform's second quarter results showed total active users rose 27% to 551 million. The company cited strong growth in all regions, especially among Gen Z listeners. Yesterday, Spotify announced its first price hike since its launch. Its premium plan will increase by $1 to $10.99, right in line with Apple Music and Amazon Music, who also raised their subscription prices. Steve?
Thanks, Lisa. Twitter is facing a string of problems with its new branding. Bloomberg's Kimberly Adams reports.
Experts tell Bloomberg turning the platform name into X is set to kill billions in brand value. Elon Musk announcing the product name change and getting rid of the bird logo and all the associated words, including tweet, wiped out anywhere between $4 billion and $20 billion in value. The company has already declined significantly in value since Musk purchased it back in October for $44 billion. Terms like tweet have become a part of popular culture.
Thanks, Kimberly. UPS and its customers can breathe a sigh of relief now that a labor contract has been reached. The Teamsters say a 5-year tentative deal will raise wages for all workers, creates full-time jobs, and includes dozens of workplace protections. Currently, shares of UPS down now 1.75%. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Mint and Paul Sweeney here in the Bloomberg Interactive Broker Studio. We are streaming on YouTube. Head over to YouTube and search Bloomberg Global News, and that's where you'll find us. Looking at the markets here, a little bit of a lift here to the markets before we get a lot of tech earnings after the close. S&P 500 up 0.3%, NASDAQ up 0.8%. And we're going to call out crude oil because it's moving higher yet again today, up 1%. WTI crude oil, $79.57. So continued to move higher. There expectations that demand will pick up globally amidst fixed and kind of tightening supply from OPEC. So we got a little bit of that dynamic going on. Right now, let's go to Nancy Lyons down in Washington, D.C. for world and national news.
Thanks, Paul. Saying it's hard to fathom what the family went through, President Biden is taking steps to commemorate Emmett Till and his mother. Till's brutal death at the age of 14 spurred on the civil rights movement.
Today, we join together as I sign a proclamation designating Emmett Till and Mamie Till Mobley National Monument in both Illinois and the Mississippi.
With the stroke of Biden's pen, the Emmett Till and Mamie Till Mobley National Monument will be federally protected places. China is replacing its top diplomat after just 7 months on the job. The nation's top legislative body says Qin Gang will be replaced by his predecessor, Wang Yi. That's after a snap meeting was held without explanation. We get more from Bloomberg's Enda Curran in Washington.
The replacement of Qin Gang as foreign minister, that does end a month of speculation. We had a very extraordinary situation whereby China's foreign minister disappeared from the world stage. He was replaced by Wang Yi, and that seems like that's going to continue from here on.
Bloomberg's Enda Curran reports the foreign ministry has only said that Qin was suffering from a physical condition but did not give any other details. Florida Governor Ron DeSantis is said to be fine after being involved in a car accident in Tennessee this morning. The crash happened while the Republican presidential candidate was traveling to an event in Chattanooga. His campaign says DeSantis and his team did not suffer any injuries. Bronny James, the oldest son of the NBA's LeBron James, is said to be in stable condition after going into cardiac arrest during a basketball practice yesterday at the University of Southern California. The younger James will be a freshman at the school this fall. The family has issued a statement thanking the USC medical and athletic staff for their incredible work and their dedication to the safety of their athletes. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Jess.
Thank you, Nancy. We appreciate it. Jess Mint and Paul Sweeney here at the Bloomberg Interactive Broker Studio. And all eyes after the bell, Paul, when it comes to Microsoft and Alphabet. This earnings when it comes to the AI hype that broke out in the second quarter. So this is the first big reading on that. But as you know, Microsoft still generates billions from its software products and its cloud business. While we know with Google, it clearly comes to its ad engine. But nonetheless, it's going to be key to see what their commentary is about AI here.
Yeah, because, I mean, we had the NVIDIA raise last quarter. It was just a huge raise in the revenue forecast, and that just opened everybody's eyes, it seemed like, to the upside and the potential and the market size of all things artificial intelligence. And the markets has been ripping since then, particularly some of the big tech names. And a lot of people, I think, are correctly asking the question, all right, where's the beef? What's kind of behind this AI thing? Can we start framing it out? And so, as you mentioned, Jess, a lot of companies that will be reporting their earnings this quarter will be asked to put a little bit more meat on the bone there about what AI means to their business. And again, you know, Microsoft and Alphabet after the close today will be big, and the stocks are already really reflecting a lot of upside. Microsoft shares have soared 45% in 2023, hitting multiple records in a rally that has left it on the cusp of joining Apple as the only two companies with market valuations of $3 trillion. So
also,
big.
Trading around 31 times forward earnings for Microsoft, just a little bit ahead of when you're looking at the NASDAQ 100. But Gina Martin Adams over at Bloomberg Intelligence has talked about how the concern about concentration, if you look back through history, it's not necessarily always a bad thing, and you might continue to see this move higher from here.
Yeah, it is. And the valuation is something that Anurag Rana, who covers the stock for Bloomberg Intelligence, brought up, because he remembers the day when this thing was trading at 12 to 15 times earnings, and now you've got it north of 30. So a different story there. All right, coming up, Sound On with Joe Matthew. That starts right now.
Republicans are unveiling a new bill for crypto oversight. We're going to discuss that more with House Financial Services Committee member Congressman Frank Lucas.
And navigating through shifting market structure amid regulatory uncertainty, we'll speak to the Wintermute founder and CEO, Evgeny Gavoy.
Plus, OpenAI CEO Sam Altman's crypto project WorldCoin makes the official debut. Investors are piling into the project's token amid the hype around artificial intelligence.
All right, so there's hype there, and all of that is ahead. But first, let's talk about where there isn't that much hype in crypto markets and take a snapshot of them. You can see this on CRYP Go on your Bloomberg terminal, and what you will find is it is a relatively quiet day. Bitcoin and Ether are only up by about 0.3% respectively. Bitcoin right now trading at $29,227, and then XRP, of course, the token that was front and center in recent weeks after that ruling between Ripple and the SEC. It seems like some of that hype is fading a bit. XRP is down by about 0.5% today. The one outperformer I wanted to point out, Shanali, is Dogecoin, outperforming for a second day, up 6.3% or so today. This is all on the idea that it perhaps is going to get integrated into X, Elon Musk's rebranded Twitter, in regard to that payments that it is expecting to include. So that's where some of that is coming from, and Dogecoin certainly benefiting from that. As we've often seen, Elon Musk has the power to move that token, Shanali.
He certainly does. A lot on Dogecoin in the last year or so, but I have more on how the hype has been cooling over the past year or so. Just take a look at this, Kaylee. It is the movement into exchange-traded products for crypto here. You have had about $500 million flow into the industry over the last several months, but this has been at the pace of hundreds of millions over the last couple of weeks. That has cooled down in the last week to just over $1.6 million. So a drastic change in the flows in. Still positive, but certainly that hype over there is cooling.
Okay, so maybe a little bit of fading optimism, but it does still seem, Shanali, like crypto investors are the most optimistic they've been in over a year about the odds of the world's biggest Bitcoin investment product being allowed to be turned into an ETF. Grayscale CEO Michael Sonnenschein spoke to Bloomberg about the decision.
GBTC is a product that's actionable for investors today. It has a 10-year track record. It's the largest Bitcoin fund in the world, and an operational track record of success at that. And so you contrast that with a lot of the other filings out there, which are merely just proposals hoping to come to market. But regardless, we are prepared for a world in which there are multiple products. We should expect a decision by the fall at the latest from the DC Circuit. The decision could come out of the court any day.
Joining us now is Bloomberg's Katie Greifeld, who had that conversation with Michael. So, Katie, when he says any day, realistically, when do we expect this, and what happens next?
Well, you heard it from Michael Sonnenschein himself. By the fall, for Bloomberg Intelligence specifically, they're expecting by the end of September. But like Michael Sonnenschein said, it could come any day that we're expecting a decision from the D.C. court. They tend to post their decisions around 11 a.m. on Tuesdays and Fridays, so a lot of people have been refreshing that page. But given that we had oral arguments all the way back in March, it makes sense that sometime in the fall we should finally get a decision on what's been a huge story to follow, both for the crypto industry and the exchange-traded fund industry.
Do you think that the investor base around GBTC is very bullish on GBTC, especially given that they're going to face competition here? You're seeing the gap narrow when it comes to their discount here, except for it's still come down a bit over the last couple of weeks or so. Is there a chance that BlackRock just wins out here?
So that's where this conversation gets really interesting. Just in the past month and a half, of course, BlackRock coming out with that spot Bitcoin ETF filing. Who knows when that will be approved? The absolute maximum for the SEC to make a decision on that is 240 days. You could enter into a scenario where some of these spot products start to launch, and this case between Grayscale and the SEC hasn't been resolved yet. So that's one of the many storylines that we're following here. But really, for most of its existence, GBTC has really enjoyed the fact that it's one of the only products out there in a fund-like structure. It's a trust, it's not an exchange-traded fund. But now you're entering a scenario where if BlackRock and some of these other heavyweights who have come forward, I'm thinking Invesco too, if they come out with spot Bitcoin ETFs, and who knows what they'll be priced at, that's obviously a lot of competition.
All right, well, Bloomberg's Katie Greifeld will continue to wait for that ruling. Thank you very much. And while we wait for clarity from the courts, Republicans in the House of Representatives are attempting to provide regulatory clarity for crypto markets through legislation. The House Financial Services Committee will be marking up the Financial Innovation and Technology for the 21st Century Act tomorrow. It's a market structure bill that looks to delineate authority between the CFTC and the SEC. It's a joint effort between the Financial Services and Agriculture Committees. And I'm pleased to say that joining us now is a member of both of those, Republican Congressman Frank Lucas of Oklahoma. Congressman, thank you very much for your time today. Let's begin with the markup in financial services tomorrow first. Will this bill find your support in that committee, and do you think it has enough support among your colleagues?
Well, first off, I suspect we'll go through an extensive amendment process tomorrow in financial services. We're successful there. The bill will pass out. We'll go through a similar process in the Agriculture Committee because it's a split jurisdiction. But yes, I believe it's time to bring some certainty to this process. I will give Chairman McHenry of the Financial Services Committee and Chairman Thompson of the Ag Committee high marks for working really hard to get us to this point. The number of hearings, the number of briefings, the number of roundtables, the number of stakeholders we've listened to is really quite incredible. But this is a complex bill, and we'll see how comfortable the members are. Will it pass unanimously? Probably not. Will the Republicans overwhelmingly support it? I believe so. Will we get Democrats? I think so. Do we have wild cards on both sides of the room in the R's and D's? Absolutely. That's the nature of this complicated session of Congress.
Yeah, well, this is Washington in 2023. Congressman, what are you hearing, though, from your Democratic colleagues on this matter?
I think they're generally supportive. There is some hesitation. You have to understand that a lot of it depends on your philosophical perspective. Most of my conservative colleagues, without regard to party affiliation, view this potentially as where financial transactions go. View this as a legitimate effort that's been evolving, and it needs to have certainty and regulation to move forward. Some of my more liberal colleagues, I think, are a little hesitant about creating parallel ways to move resources because they would like the government and the traditional payment system to control everything. But we'll work our way through that tomorrow. But also remember, this will be a committee markup in Financial Services and Ag this week. We will still have to go to the floor. The Senate will still need to do something. We'll still wind up with a conference committee report or a final version of a bill that then goes to the president's desk. So we've come a long ways, but this is just the first steps to get to the end.
Congressman, what is the Democratic compromise here, knowing that there are a large group of Democrats that don't necessarily agree with the bill as it stands today?
I don't know that I can answer that question. There are a handful who just philosophically don't believe that resources should be able to pass through sources outside of the government. If you want to tax everything, if you want to regulate everything, then you want to keep it close to where Uncle Sam the Federal Reserve System and Treasury can keep a grip. If you believe that resources should move where the economy and the markets dictate, which tends to be more of my, my conservative Republican colleagues, then you're generally supportive of this. But the markets, the consumer reaction has been so far, we want to do this. Now, regulatory certainty, competing in the international financial world, and safety for people making these investments using these avenues, that's critically important. And that's what this bill is all about.
What does this mean for the control that the CFTC has over the crypto industry vis-a-vis what the SEC will be overseeing moving forward under the new constructs of the law?
Well, I've been a part of both ag committees for almost 3 decades. There's different perspectives from how the Commodity Futures Trading Commission functions from the SEC. The Commodity Futures Trading Commission is proactive. The SEC is reactive. SEC tends to be, at least under its present leadership, more control-oriented generally about everything. Bottom line is this. The fact that the two chairmen are working so methodically together says that there is a way to achieve a consensus. Now, we still have to have the Senate, and we still have to have some other folks participate with us, but we can't continue in the Wild West format we're working in right now. Our international competitors will eat us alive, and we'll continue to have circumstances where, sometimes $1 billion at a time seems to disappear. That's unacceptable in the format we're working in now.
Congressman, you alluded there to SEC Chair Gary Gensler, who obviously was dealt a bit of a blow in court recently in regard to the Ripple case and whether XRP was indeed a token, the court ruling that it is not when sold to retail investors. Do you think court decisions like that build momentum in Congress toward making this delineation, deciding what the SEC ultimately has authority over?
It is stressing the urgency for Congress to react. The courts, depending on which court it is, depending on which judge it is, depending on the nature of the case put together, you get a variety of results. That's not just in these issues, but all issues. It reinforces the fact we need to provide some certainty. We'll see if we're capable of starting that process this week. Again, I give my full committee chairman, McHenry, and G.T. Thompson much credit for getting us to this point. But it's a big boulder we're pushing up a tall economic and political hill.
And Congressman, final question for you, just given your role on the Agriculture Committee, the Ag Appropriations Bill now seems to be the subject of debate over culture wars. There is also several conservative colleagues that you have that are pushing for reductions in SNAP benefits. Congressman, what is your take on all of that?
The House of Representatives is a very intense body. The Republican Conference is a very intense group of conservatives. We're going to have challenges in every piece of legislation that goes across the floor. We saw this in NDAA. We're not going to see this in the approach process. We'll see it in the Farm Bill. Remember, the House passes language, the Senate takes action. We have to reconcile the differences in a conference committee report. Conference committee reports require a majority of the House and the Senate, a majority of the overall bodies. The final product may not look like everything that originally leaves the House or the Senate, but that's okay. It's called legislating.
Indeed it is. Well, Congressman Frank Lucas, thank you very much for joining us with your take on some of this legislation. Good luck in tomorrow's markup. We appreciate your time. Now, coming up, we will be speaking to the CEO of Wintermute on how his firm is working to protect investors. That's next. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
As we thought
thought about being an operator of a custodian solution, being a custodian in the U.S. market, we also do like to be able to operate in a pretty well-regulated environment and a well-understood regulatory framework. And right now, that regulatory framework's changing. So we decided to halt those efforts right now and really just focus in on the tech business and on the listings business.
That was NASDAQ CEO Adena Friedman speaking to Bloomberg after halting the operator's plan to launch a crypto custodian business in the United States. Now, while some might be pulling out of the crypto space, the crypto algorithmic trading firm Wintermute is optimistic. Now, they're seeing volumes move from exchanges to over-the-counter. Wintermute founder and CEO Evgeny Gaivoy joins us now. Evgeny, thank you so much for joining us, because the question I have under the surface here is, what does it really mean for more activity moving off exchange?
Yeah, I think, first of all, thanks for having me. I think part of it is basically, yes, a reaction to the last year events, the collapse of FTX, general, like, people not being super excited about storing their assets on exchanges as well, especially centralized exchanges. And so people are looking for basically to deal on OTC side of things, where markets are potentially, well, where they're effectively protected by connecting to truth custodians, by connecting to like relatively familiar setups for them, like prime brokers, for example. And I think that's basically what drives it.
I'm curious what this means for trading, especially when it comes to trading not just the core products, but derivative products here. How do you know that your money is safe when there's so many big questions around custody and so many big questions about how the derivative market has been growing around the crypto industry?
Yeah, I think it's all about basically trusting your custodian. I think basically this topic of custody, I think this NASDAQ news was quite interesting in that regard. This topic of custody will be a pretty big one over the next years. Like, it's not just this year or next year, but over the next 10 years even for crypto, because it's one of the key things to figure out. And it's basically one of the key aspects of basically how spot trading would work. But back to derivatives, one nice thing about derivatives is that they're cash settled, so you don't need to necessarily solve the custody part, because you can just deal with in stable coins or even dollars. And that basically solves a lot of pain points currently for anyone who wants to get exposure to various crypto assets.
Evgeny, we were just speaking with Congressman Frank Lucas about the efforts underway in the U.S. Congress to create some regulatory clarity for digital asset markets, delineate what the SEC and CFTC each have authority over. In the absence of that regulatory clarity here in the U.S., how hindered is the industry?
I think a general trend that we see is that a lot of protocols, a lot of exchanges are just being on a very careful, safe side by simply closing them completely to US at the moment. So, like, we know protocols, we know exchanges that are just being completely closed off. And I think this trend will continue until we get this regulatory clarity. And what we'll end up with for US investors, for example, is they will potentially be sidelined from, like, whatever new exciting things happens in crypto.
Give us a picture of what it looks like under the surface here. Is there a question of liquidity being robust enough, given the amount of players that have stepped out as they're awaiting regulatory clarity?
Yeah, it's an interesting question. On one hand, we definitely see a number of US-based competitors of ours pulling out of crypto markets completely. On the other hand, I can also see that, for example, European prop trading firms are scaling up. We see increased competition from that side. Asian prop trading firms are still around as well. So it's basically kind of like shifting competition, which is natural. And I think it's like, for us, it doesn't really change anything from that regard. And for the market as a whole, liquidity might be less on centralized exchanges, but for example, OTC competition is pretty significant.
How much money is actually moving offshore based on what you're seeing today?
Yeah, that will be pretty tough to estimate and kind of separate from general bear market volume drop. But yeah, my guess would be, well, I mean, if you simply look at Binance volumes, for example, they are, well, significant double-digit percentages, and they're like multiples of their rivals in US, for example. So that's already one interesting point to look at.
That's Evgeny Gaivoy, founder and CEO of Wintermute. Thank you so much for your time. And coming up next, WorldCoin saw a strong trading debut on Monday, but the eyeball scanning crypto project is not available to trade in the United States. More on that next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
News breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI, sort of trade here.
The $69 billion deal is the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Bloomberg Crypto. I'm Kaylee Lyons in Washington with Shonali Bosick in New York. Well, Bitcoin today is floating back above that $29,000 mark, but there's something else that's grabbing more attention. The weekend box office hit, Barbie. It's been getting more media coverage on the Bloomberg terminal than Bitcoin has in the past 5 days. Just ahead of the toy maker Mattel's earnings on Wednesday, we have a great chart that shows that coverage on the Bloomberg terminal. I personally have my tickets to go see Barbie tomorrow, so I will be buying into all of that hype. But there is something that has outshined Bitcoin this week in addition to Barbie. It's the crypto project co-founded by Sam Altman. It officially launched on Monday after surviving through 3 tumultuous years in the industry. The CEO of OpenAI said in a statement that WorldCoin is an attempt at global scale alignment. The journey will be challenging and the outcome is uncertain. Well, joining us now to talk more about that is Bloomberg's Joe Weisenthal. So, Joe, this is an eyeball scanning project. It creates a digital identity, proof of personhood, the company says. But is this basically just the ultimate hype sandwich, crypto and AI smashed together?
I mean, it kind of is. I've been so fascinated by this company for years since it's launched, because the idea that we're all going to get this like big orb, and they have this like multi-pound orb, and I've held it, and it's going to scan your eyeball, and it's going to create a unique form of identity, and you're going to get a universal basic income through that identity, and it's related to crypto on its wallet. It's like so like everything, as you said, this sort of like maybe like a hype sandwich. But on the other hand, when you think about AI and you think about the various risks, whether it's sort of disruption to jobs or the idea that an AI could, say, impersonate a person or impersonate a loved one, et cetera, are you really the person that you claim to are? It's kind of like a very like interesting, ambitious problem that they've tackled. So even as weird as it sounds and everything, like I'm kind of just like absolutely fascinated to see where it goes.
Speaking of the risks here, what are the security risks of the eyeball scanning that is happening here, and tying it to your economic future? I mean, are there real concerns behind the project?
Absolutely. I mean, they're scanning your eyeball. I mean, mean, obviously, there have been some criticisms about privacy and whether there's a database. They claim that there will be none, that all of the logic is not in some centralized database like, say, the Social Security Administration, which has a database of everyone's Social Security number, that it's this unique hash that all the logic is in
more or less hackable, the Social Security network or the world.
Right, yeah, and they say no, and that they have like 13 ways of scanning your eyeballs, so like they can tell maybe if you're like under duress if someone's like put your face in front of one of these scans or something. But it's like pretty sci-fi stuff, and I don't think anyone really knows like where it's ultimately going.
That's like that technology itself, but then there also is the token that had such a phenomenal debut yesterday, Joe. But it's worth noting you can't trade it in the U.S. It's just another example of the regulatory environment here limiting what people can do.
Yeah, I mean, there's regulatory elements. I mean, and there's also the question of like, why do we need a token associated with it? Feels very like 2021 or 2020. Their argument would be that if you're going to have this sort of system of identity that everyone is one day going to depend on in order to prove their humanhood, collect their UBI because the AI put us out of a job, etc., then it has to be distributed and distributed governance, and it can't just be controlled by one company that is like connected to Sam Altman, etc. So of course, the argument that they would make is that, well, this is what crypto is good for, distributed governance, etc. On the other hand, people look at this coin and they say, oh, there's like really low float, and it's just a classic thing where because there's so much hype and because there's so few coins out there, it like shoots to the moon and it's a fortune already. So it's sort of like, okay, like I can accept the crypto logic, but also the reality is like it is what it is, this huge like, this massive like pump for something that like has not borne out what it said it's going to do.
All right, Bloomberg's Joe Weisenthal, always great to get your hot take. Thank you so much for joining us. That wraps it up for us on this Tuesday, but make sure to tune in next week. We'll be talking to Gary DeWall, Senior Counsel at Catton. He'll be joining us then 1 p.m. Eastern Time on Bloomberg TV. This is Bloomberg.
From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The names that move markets are on Bloomberg.
China has
seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Markets. I'm John Ehrlichman.
And I'm Shonali Bassick. Matt Miller is on assignment today. We're going to get a quick check of the markets first, John. I am looking at the S&P 500 up about 0.4%. Matt is off today. Markets are calm. We're looking at the 10-year yield just down just a little bit on the day here. Actually, up, sorry, about a little bit on the day. 389. We're looking at the U.S. dollar also. A little bit of cooling here. The 2-year yield is also a little bit down on the day. No crazy moves here. We are watching a 1% jump in New York crude as well. But again, all pretty stable over here.
Yeah, and energy stocks on the move, Shonali. And then, of course, earnings season has arrived. Everybody's curious about the outlooks. Let's go through some of them. You've got more than 6%. The renewables and aerospace outlooks satisfying investors. 3M's outlook doing the same thing. Those shares are up about 5% right now. The cost-cutting initiatives there seem to be taking hold. Not all names are higher, though. General Motors put together a solid quarter. Actually had some encouraging things to say about the outlook. But the GM worries seem to be weighted tied to the electric vehicle transition, how long that's going to take for General Motors. So we've seen GM under some pressure in trading today. The strike uncertainty is also in the air right now. Speaking of the air, Alaska Airlines is one of the names we've been tracking as well to the downside. At this hour, Shonali, they're down about 9%. And even though there's been plenty of travel this summer, in the case of Alaska, all that foreign travel is impacting their domestic demand, and ultimately that impacted their performance.
Absolutely. And John, we're going to switch gears here from the markets to the Federal Reserve and the economy, because studies have shown, including research from the Fed, that high interest rates are making the income gap worse. And according to our next guest, communities of color are paying higher interest rates than their white counterparts. Nicole Elam, the president and CEO of the National Bankers Association, joins us now to talk about just what these ripple effects look like of higher interest rates just before another big Fed meeting. Can you talk to us a little bit, Nicole, about the way that rates have been impacting communities of color already?
Yeah, so tomorrow, as you mentioned, we do expect the Fed to increase interest rates, even if it's just by 25 basis points, continuing its trend of increasing interest rates in order to cool off the economy, stop inflation, and to slow down consumer and business spending. But as you mentioned, communities of color already pay higher interest rates. And so these are the communities that are going to be disproportionately impacted by the higher interest rates. Take minority small businesses, for example. Their interest rates are already 1 to 1.4% higher than their white counterparts, even when they have the exact same credit profile. Communities of color are 62.5% more likely to have a higher interest rate than their white counterparts, even if they have the exact same credit profile. So these are the communities that are going to be hit the hardest by the increased interest rates.
How much of a delayed effect is there? Because we know that small businesses are some of the largest employers in the country. Are you seeing the same small businesses that are finding it harder to get a loan? Are you seeing them have more pressure on their job forces as well because of it?
Absolutely. When you think about small businesses, over half of them say that their top concern is inflation and the rising interest rates. Why? Because it drives up the cost of them doing business. And they are 99% of the firms in the U.S. They're small businesses. They employ over 50% of the private sector workforce. And so these are really key folks who are making unemployment or making employment happen in communities. But unfortunately, when you think about small businesses of colors, these are the ones that oftentimes have the hardest time accessing credit and capital. So when you think about an interest rate environment going up and this inflationary environment going up, it's going to make their cost of business go up even more. And what do people do? They try to cut their cost. And unfortunately, what's going to happen is that it's going to lead to unemployment. They're going to have layoffs. And that unemployment is going to impact communities of color the most. What we know about the unemployment gap is that communities of color are oftentimes the first ones who are laid off, who are in roles and who are in industries that are the most most impacted by it. So you're going to start to see small businesses clamp down on their spending, and you're going to see layoffs that is really going to exacerbate the racial disparities that already exist and the unemployment gap.
Nicole, in a rising interest rate environment, when there are those challenges you speak of, some people say, well, you can offset that with the interest rates you can get through things like high interest rate savings accounts. But what does your research tell you about that?
So the research says that it's oftentimes these communities either can't or don't take advantage of the benefits that happen in the high interest rate environment. So these high yield savings accounts, CDs, that oftentimes earn 10 to 12 times higher interest rate than your traditional savings account, they aren't taking advantage of these opportunities. And so when they have cash, whatever cash that they have, because of the income gap and the wealth gap, they oftentimes don't have a lot of cash just sitting around. But whatever cash they do have, they are not putting it into these high yield accounts. They're keeping it as cash, or they're just keeping it in a traditional savings account. So they're not even benefiting from the good things that happen in a high interest rate environment. So they are being hit on the employment front, they're not taking advantage, and their cost of borrowing is going up. So they're really getting hit all the way around.
And then I know that you've also done some research to look when you have people that have similar credit profiles, and yet at the when it comes to actually getting that credit at a reasonable rate, there are some discrepancies there.
Yeah, so access to credit is oftentimes more difficult for communities of color. They are denied at a rate that is 2 times that of their white counterparts, even when they have the exact same credit profile. So they're denied at higher rates, their interest rates are higher, and they're oftentimes approved for less than the full amount that they are requesting. And so what does that mean? It means that oftentimes they are looking to credit cards to fill in the gap. So when the cost of borrowing goes up in this type of environment, your cost to get a small business loan, your cost to get a mortgage, your cost to buy a car, when those costs start to increase, you turn to credit cards. And so the impact of that is that you start to see credit card debt increase. And unfortunately, in this environment, the interest rates on credit cards are oftentimes also increasing. So their debt is continuing to grow as they're looking to credit cards to make up the difference because they can't access capital and credit in the same way.
Now, what does this mean for how you feel about any future rate hikes? Are you concerned that the negatives here of making it harder to get a loan does outweigh the benefit of reducing inflation? How do you feel at this point?
So I certainly think that the federal government is leveraging the tools, the monetary policy that they have. You certainly have to get a handle on inflation. The thing that you have to think about, though, is its negative consequences. The fact that it's going to make the cost of borrowing more expensive for communities of color. And it's not just the cost to borrow to buy a house, to buy a car, to buy consumer goods, but also your cost to keep these things. If you have an adjustable rate mortgage, your rate is probably going to increase, so your monthly payments are going to increase. If you've got a small business loan and it's maturing, that rate is going to increase. And so you have to think about things that aren't outside of just the monetary policy, but what are other tools that are available to think about the unexpected consequences that are going to happen from unemployment, the higher cost of borrowing, the over-reliance of credit cards.
Nicole, helpful context. Thanks very much for your time today. We appreciate it. Nicole Alam, National Bankers Association CEO, joining us ahead of that next Fed decision. Today, we've got earnings on deck. Microsoft and Alphabet out after the bell. Our stock of the hour is next. This is Bloomberg.
What do you like most about your job? I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
Look, I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Markets. I'm John Ehrlichman with Sonali Basak. Time now for our stock of the hour. Google's parent Alphabet reporting earnings after the bell. Now, shares are up nearly 40% this year. Investors are going to be watching, though, for signs of a recovery in the digital ad market. Of course, there's plenty of questions right now about the core search business as Alphabet deals with competition from a growing list of AI rivals. Ali Moghrabi is a senior equity analyst at Morningstar, and he covers the company. He joins us now with a preview. A lot on the agenda to be watching for, Ali. What are you going to be watching for?
Even though it's short term, but actually the impact of AI, generative AI, whether it's from Microsoft's Bing or whether it's from OpenAI's ChatGPT on their overall search. Of course, initially to begin with, you expect less ad spending this year anyways, but in terms of how the commercialization of those products may have impacted search, that's one of the most important things. And the other one is YouTube, whether the monetization of YouTube Shorts has actually picked up and therefore, may have accelerated a little bit of a recovery or growth rate in YouTube revenue, in YouTube ad revenue, I should say. So those are a couple of things. And then the third thing is we look for further improvement, again, for the whole year, actually, in their cloud business. Because if you think about it, the emergence of AI, specifically generative AI, that requires a lot more computations, training, inference, and so forth. So the hyperscalers, the cloud providers, the demand for their services, we think has probably gone up a little bit and is probably going to continue throughout the rest of the year.
How much is a little bit,
though?
three
things we look for.
Yeah, how much is a little bit, though? Because obviously there's so much hype around AI. Everyone is talking about it. People want to invest in it. But at the end of the day, how much does it mean for how quickly Google is able to monetize this?
If you're asking about the search side, I think it will be gradual because you have to take into consideration human behavior. As you know, Google has become a brand. I Googled it and so forth. It's become a verb that all of us use, many of us use, or I should say most of us use. So how long, actually, the question of how long it's going to take to change our behavior, that remains to be seen. So we're assuming that change is going to be gradual, probably throughout the next 18, 24 months. And also, of course, we're not necessarily assuming that utilizing generative AI and search is going to completely replace that traditional listing search. We think it's actually going to be a pretty balanced mix of both. It really depends on what types of question one is asking in search.
Ollie, what about the cost of doing business? At least in the case of Alphabet, we often talk about Google's traffic acquisition costs. Is that something you're going to be watching closely?
Yes, certainly. Given the potential threat, although we think that Google is going to maintain its over 90% market share in search, but given the potential threat of what Bing and ChatGPT have done, we think that they may face some pressure in the fees that they pay for traffic acquisition costs, more specifically to Apple and Samsung. That remains to be seen, but that's one thing to watch for is the traffic acquisition costs, and whether they have increased, and if there were any indications that Apple may place a little bit more pressure on Google.
You know, we're thinking so much about YouTube and ad revenue. I'm curious about how you see some of these trends floating through the industry when you're thinking about what Meta or Snap might experience.
Yes, actually, both Meta and Snap are facing the same, I wouldn't necessarily say issue. Of course, from a macro environment, there are uncertainties, and that certainly impacts ad spending. But the issues are regarding the monetization of the features that they've added that pretty much replicate what TikTok has done. So, and that's been basically pretty gradual. You know, we've seen examples of that in Meta's case, as it was very successful with Stories when it copied and pretty much pasted what Snap had done. It took a while. It took about a year and a half, but the monetization continued to improve over that period, and it's been very, very successful. So we view the same happening with all three, but again, it will be very, very gradual. I would say that we're expecting for Meta to be a little bit further along in terms of monetization of its Reels than YouTube Shorts.
That's Morningstar's Ali Moghrabi. Thank you so much for your time. We want to bring you now some breaking news. We have Deutsche Bank is going to resume share buybacks of up to 450 million euros. Now, this is according to a statement. This is ahead of Deutsche Bank's earnings that will come in European time overnight as well, and a little sign of strength before we get new international capital standards for the banking industry. Now, we're also going to look ahead to Microsoft's AI progress and the Activision deal after the bell. When you're thinking about this, John, I mean, what are you going to be watching for when you look at Microsoft? Frankly, all I can think about is Activision.
Well, you know, that was a huge hurdle for the company. There's undoubtedly, but at the same time, just building on what Ollie was just talking about with Alphabet, there's a lot of AI hype in the air, and obviously Microsoft is one of the companies putting pressure on Alphabet right now, but some of that is not fully realized at this point. You know, you've got their cloud business, their traditional cloud business that has started to show some sluggish performance compared to what we saw previously. So there is a potential scenario, Shanali, where you have a quarter that doesn't necessarily live up to the stock market expectations. Microsoft shares have had a huge run this year, but I know an analyst today at Macquarie said long term you got the AI opportunity, and that's going to feed into all the Microsoft products, so they raise their target price.
Seriously, everyone's watching the new businesses, but it's really the old businesses that are the big money businesses, right? Coming up, we have Spotify. It has its worst trading day since October after reporting sales that came up short of estimates. Those details are next, and this is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food. It gives us jobs. It gives us, of course, oxygen. We're taking too many fish out. We're polluting it. We're making it warmer. And only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about
how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg TV and Radio.
This is Bloomberg Markets. I'm Shonali Bassett with John Ehrlichman. I want to bring you back to some breaking news. We had Deutsche Bank to resume share buybacks of up to 450 million euros. Let's take a look at that stock price in U.S. trading here. We are seeing them trade a little bit higher. This is good news for investors. Again, this comes ahead of Deutsche Bank's earnings release that will be overnight in Europe time. Keep an eye out also. Bloomberg Television does have an interview with Deutsche Bank CFO James von Moltke. Now, let's look back at Spotify because shares are lower after reporting weaker than expected sales and issuing a weak forecast. Bloomberg's Ashley Carmen covers all things podcast and audio for us. Ashley, thank you for joining us. You know, what does this all mean for Spotify, especially with the changes that we've seen in their pricing?
Yeah, so I mean, you can see the pricing as a direct response, I feel like, to what was coming in these earnings, which is that their average revenue per user is declining despite their user base growing pretty substantially over the past year or so. So really what you're seeing is this effort to raise prices in an effort to grow the amount of money and revenue and eventually, hopefully, reach profitability eventually.
And I guess, Ashley, in the interim, that need to control costs is one of the other realities that this company has been highlighting to investors.
Yes, 100%. They have cut staff multiple times over the past year. They cut employees in January, a significant percentage. They also cut a bunch of podcast staff in June. And we also broke the news that they are looking to sublease some space, particularly in New York, to cut back on real estate costs. That's in addition to just the general cost cutting we see in various companies like travel, food, things like that.
You know, and on the revenue side, you mentioned increasing profitability, but if you're raising prices, what are you sending a signal to your clients, to the users? Is there a lot of competition in the space in terms of the stickiness of people sticking around under the new pricing regime?
Yeah, so Spotify hasn't raised prices in the U.S. since its launch. So this is a pretty big deal that they're doing so now. That said, Amazon Music and Apple Music, their primary competitors here, have also raised prices to the same exact cost. So presumably the competition, honestly, the investors have been wanting Spotify to do this because they believe that they'll be able to maintain their user base.
At the same time, Ashley, we are talking about a company that has now amassed, I believe, 220 million paying subscribers around the world. Does that afford them the moat, if you will? I mean, obviously, you're competing with Apple, but is it their game to lose in the audio sector, assuming they can get things right with how much they spend and where they place that money now?
You know, that's the big question, and I think that the dark horse that we're sort of watching here is TikTok. They just launched TikTok Music in various territories, not in the U.S., and they obviously have such a stranglehold on the Gen Z audience. So really what's going to be critical moving forward is how quickly and how effectively Spotify can bring Gen Z over to their platform and potentially not lose them to platforms like TikTok or YouTube.
Speaking of losing them to other platforms, I mean, what does this mean for what they're going to be paying up for content? I mean, are there other kind of costs that they're going to have to contend with here as they kind of navigate this price hike? Does it work? Does it not work?
Yeah, so really the place that they were spending so much money was the podcast division. I mean, they were, they did huge high-profile deals with the Royals, with the Obamas, with Kim Kardashian, and what we're seeing now is them kind of cut back on that cost because that was their differentiator, was they thought if we have these podcasts, that makes us different from the other competitors. Seemingly they're backtracking a bit bit on that. They still have some licensing agreements, but we'll see how they kind of put together an original content strategy moving forward.
All right, a helpful roadmap. Ashley, thanks so much. Ashley Carmen, who covers Spotify for Bloomberg, joining us. And let's get to today's For What It's Worth. How about $20 billion? Analysts and brand agencies interviewed by Bloomberg estimate Elon Musk's decision to ditch the Twitter name could wipe out between $4 and $20 billion worth of brand value that is associated with Twitter. And that would also include, Shonali, the bird logo and all the associated words like tweet. Of course, brand valuations, these are pretty hard to measure, but he's moving fast, and people are trying to crunch the numbers on the go here.
It's amazing crunching the numbers that quickly. It just happened, didn't it? But I guess it's all in a brand.
No, it's true. And even these questions about the X brand itself and who has the rights to those brands. But I think one of the things Musk keeps talking about is he wants to hit the go button on what could be an everything app. Can this be like a WeChat, a model that hasn't quite worked in North America yet the way it has in China, partly because of the way the banking system works in North America, which you cover so extensively.
And we've been hearing about this everything app forever, John. Let's see if it actually ever happens in our lifetime. Well, right now, separately, Elon Musk is speaking at the PG&E Innovation Summit. You can watch that on Live Go on your terminal. And for John Ehrlichman, I'm Shonali Bassett.
Well, that's how
Keep an eye on Musk and that everything app.
We're making
this is Bloomberg.
Together, and you're joined by...
Wednesday, the market expects another rate hike.
They're getting the message loud and clear. The Fed wants to go again.
The then what is the big mystery.
But will it be the last of the cycle?
Is it one and done or more to come?
Does the Fed make policy based on what they're worried about or what they actually see?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Twice more is not too high of a bar.
The Fed wants all options on the table.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market volatility ebbs as investors bet on macroeconomic certainty. Live from Studio 2 at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. with about 2 hours to go. We're looking at a rally on our hands. If you take a look at the stock market, you have the S&P 500 higher by about 0.4%. A lot of that coming from big tech, and you can see that in the NASDAQ 100, that big tech benchmark up by about 0.8%. Of course, as we head into some very important earnings after the bell, you're going to catch it all here. You take a look at the bond market right now, a little bit of a rally after yesterday's sell-off. You can see 2-year Treasury yields down about 2 basis points as the Fed meets. We're going to get that decision tomorrow. Big topic conversation today. And I did want to highlight crude, Romaine. We are just about at $80 a barrel when it comes to crude oil, hovering around that 200-day moving average. We'll see if we're finally breaking out of that range on oil.
All right, whether this is a macro story or micro story remains to be seen. We should point out that earnings are in full swing, one of the busiest weeks for S&P 5 companies out there. And well, 2 of the Magnificent 7 tech stocks set to report today after the bell. Microsoft and Alphabet, easy for you to say, Katie, sitting on a 40% year-to-date price gain in their stocks, a 40% plus gain on their current and forward PE ratios. That's called multiple expansion, Katie. And the big question is whether earnings will expand enough to trim those ratios. Analysts expect Alphabet to report earnings growth of about 9% on a GAAP basis, but remember, that's after 4 consecutive quarters of declines. Microsoft projected to post double-digit earnings growth after losses in 2 of the past 3 quarters. Now, is that going to be enough? Well, you got a Fed meeting out there that could be a roadblock for some. That 2-day Fed meeting began this morning in Wall Street for the first time. It actually isn't all that plussed about it. Various signals out there showing the market has enough clarity about macro conditions and the Fed's decision. Enough so that money managers are already trading as if the rate hiking cycle is over. Option traders, they're saying, well, the S&P 500's trading range is going to remain tight, at least through the Fed meeting on Wednesday, the tightest since November of 2021. And there are some prominent calls out there, Katie, from folks out there who see rate cuts as imminent. IMF did actually come out and raise their global GDP forecast, but an interesting note out by Jeffrey Sherman over at Double Line saying that maybe their recession is closer than some people think.
Maybe so. If you've heard a lot of economists, too, pushing out their recession calls. This is actually a chart of Bitcoin, but if you take a look at the New York Fed's recession probability index, it's still showing around 70–80% odds of a recession. We know, of course, the yield curve factors into that greatly. And again, even though you do have some of the biggest names on Wall Street pushing out those recession calls, we'll see. Other measures show a different story. But all of this feeds into what the Fed is actually going to do. And we have a chart of pricing behind me. As you can see, one and done, maybe not quite. You can see that 36 basis points of hikes are still priced into this market. So it seems like tomorrow seen as a lock. Where we go from there, it seems like we see a 50% chance of whether we get another hike from this Fed. But something that officials can maybe call a win on is the fact that you've seen pricing for cuts really get drained out of this market. Just about 3 basis points of cuts are priced into 2023. As you can see, Romaine, that was 100 basis points back in May, but officials have successfully talked that out of the market.
All right, Stephen Stanley joining us right now, chief U.S. economist over at Santander, helping us kick off to the close. And Stephen, I mean, when you look at market pricing right now, most people seem to think the Fed's done.
Yeah, optimism is breaking out all over, isn't it? Yeah.
I mean, is there enough evidence, enough data out there to suggest that, yeah, they can either close the book on this whole chapter of the rate hiking cycle or at least put it on pause for an external period of time?
I don't think so. I think it's a little premature. I think people are reacting mainly to the last inflation numbers, which were much lower than expected. But we'll see. We've had several episodes over the last couple of years where inflation was down for a month or two and people got excited and then it popped back up again.
Well, that's all the comparisons everyone keeps making to the Volcker era, something similar there. He sort of really crushed inflation. Everybody thought he had slayed the dragon. And then, of course, a couple of months later, you had that resurgence here. Is there any evidence here that we could see that type of pattern repeat itself?
Well, I do think that underlying inflation pressures are still pretty intense at this point. We're seeing improvement in food and energy prices, but you know the core number was down in June, but in general it feels to me like there's still quite a bit of inflation pressure out there. So I would imagine that the Fed will want to keep their options open.
But I'm just curious though, I mean, when you listen to some of the commentary we've gotten out of corporate America, so maybe not necessarily reflected in the hard economic data, but Alaska Airlines this morning talking about their airfares are going to have to come down, at least for domestic flights. And you had other companies, car makers, basically saying they don't have the same pricing power either.
Yeah, I do think that we're starting to normalize, but I think it's going to be a slow process. So remember, you know, the Fed wants to get to 2% inflation. We've come down from high single digits down to, you know, let's call it 4 for a number. That's great progress, but it's still quite a bit away from 2.
And outside of pricing power and what companies are doing, how does the labor market factor into the inflation that's still in this economy?
Well, that's interesting because I think the Fed has traditionally been very strong on this Phillips curve relationship that basically the labor market causes inflation and is the main and not quite the only source, but the main source of inflation. And they've kind of gone away from that a little bit in the last year or so, which I think is to the good because I think that, you know, I'm not a big adherent of that Phillips curve way of thinking about things. But I think it is important in the sense that it gives you an indication of how strong the economy is and whether the economy is overheated or not. And the labor market would tell you that the economy is still pretty overheated.
And given that the labor market is sending that message, let's talk a little bit about what the neutral rate is in this economy. There's been a lot of discussion over R-star, whether you should see the neutral rate structurally higher. What's your current thinking around that?
I think it's probably higher than it was before the pandemic. There were some kind of big picture secular forces that were pushing down on interest rates over the period after the financial crisis, and probably the most important one was globalization, and it feels like that's reversed. I think the demographics are not as favorable anymore. More and more people retiring, which means the labor market is going to be tighter on average than before. So to me, you know, the Fed has not moved their long-run dot projections. They're still sitting at 2.5. That's too low in my view. It's probably 3, 3.5, somewhere in that range.
Well, that's what I'm curious about. I mean, when do we get to the point of acceptance that maybe there are some major structural shifts in our society, in our economy, that maybe a 2% neutral target doesn't really sort of matter?
Yeah, well, you need the dust to settle from COVID, and while we're getting there, we're still not there. There's still a lot of ripple effects in the economy. I think there's still a lot of liquidity left over from the fiscal and monetary stimulus. I think there's still pent-up demand in the labor markets left over from the labor shortages during the pandemic. So there's still forces that are bearing on the economy that are not really permanent. They're just ripple effects from what we saw in the last few years.
So not quite back to the economy that we saw in 2019, that pre-pandemic economy, still forces to work through there. I do want to get your thoughts on rate cuts, because we were looking at that chart just a few minutes ago that seems like the market has accepted the fact that we're not going to get any cuts in 2023.
Finally.
But when we get to 2024, I mean, you've had people come out and say March wouldn't be unreasonable, that there's reasons for this Fed to cut other than a recession. Do you think that 2024 makes sense to see the first rate cut?
I do, although I think the markets are probably a little bit early. I've got the first cut coming in the summer of next year. But I think something you alluded to is really important here, which is what is it that's driving the cuts? So there are two scenarios, really. The one is the perfect Goldilocks scenario where the economy muddles through and inflation comes down and the Fed is able to at a leisurely pace, at their discretion, move rates back to normal. Yeah. And then the second scenario is the one where the economy's falling apart and the Fed is having to hurriedly get rates down to try to support things.
Yeah, it'll be interesting to see kind of how this all balances out. But I always go back to this idea that if we got, 5.25 percentage points of rate cuts and the economy didn't break, I mean, what is another 25, 50 going to do?
It's a great point. I mean, if you go back to the beginning of 2022, so just before the rate hike started, the markets thought 2% was going to be the top of the cycle.
Yeah. All right, Steve, I'm going to have to leave it there. Always great to catch up with you. Stephen Stanley there. He's the chief U.S. economist over at Santander, helping us kick you off to the close here. A big focus coming up after the bell, a big focus on AI, tech giants Microsoft, Alphabet, as well as Texas Instruments reporting earnings. Can they live up to the hype, Katie, as the AI rally swells? We'll get a preview of what to expect.
Plus, we're going to also talk about the shakeup over at Blackstone Alternative Asset Management. Global head Joe Dowling joins on what he's doing to revamp the company's hedge fund investments.
And in our Wall Street Week Daily segment, Anthony Scaramucci over at Skybridge going to be stopping by a sit-down to get his thoughts on China, AI, and more. So a lot more to talk about here on the big program. Stick with us. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust. Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Well, 40% of the S&P 500 reports earnings this week, and it's a critical test for big tech, of course, looking to justify their valuations following the NASDAQ 100's best first half on record. The results coming after the closing bell today include Microsoft and Alphabet, and then it's Meta's turn on Wednesday. Let's discuss now with Bloomberg Intelligence equity analyst Michael Casper. And Michael, so far, the results that we've gotten so far seem to be pretty good, but it feels like we're just getting started here.
Yeah, the results so far are pretty good, like you said. We were forecasting about 8.3% growth in aggregate based on consensus bottoms-up estimates. So the estimates for the stocks aggregated to the S&P 500. We're on track right now for about an 8.1% decline. So a little bit better than that 8.3% that I had mentioned earlier. A lot of that coming from the banks, which obviously have pretty weak expectations going into earnings, and obviously they kicked off earnings season with a little bit better than expected earnings growth there. So so far so good, and we're heading into the tech season now.
Well, give us a sense here, Mike. I mean, I know it's still pretty early, but has there been a real surprise so far to this earnings season in terms of what we learned, whether positive or negative?
I think the surprise is that consensus was pretty much too bearish going into the season. And that's been a pattern for a few quarters now, at least throughout the S&P 500's earnings recession that's been ongoing, for the last 3 or 4 quarters or so, and even longer if you were to pull out energy earnings, which were a boost in 2022. So consensus, again, overshooting to the downside there, which has allowed the S&P 500 to rebound pretty sharply year to date.
And Michael, of course, what everyone wants to know is AI. How many times are we going to hear that acronym? And whether big tech can really keep this party going. But sort of the questions that I've been struggling with is, what does justifying valuations mean at this point for big tech? Because we know that we're not theoretically going to see an impact to the bottom line from AI at this juncture. So what are people actually looking to hear from these companies?
Well, you mentioned the valuations. On a relative PE basis to the S&P 500, it's 5.5 standard deviations above its pre-pandemic average. So it's 2015 to 2019 average, and that's the tech sector specifically. AI, like you said, obviously not going to be a boost, for many, many years possibly. But what we're really looking at are the expectations. So tech expectations are up about 220-ish basis points on average for the next 4 quarters. We're looking for tech to have a pretty strong beat in 2Q and to push those estimates a bit higher to justify those valuations. Now, those beats are going to have to come